The market doesn't like uncertainty. It loves it.
The acronym of Veda is AI.
I think the AI story is growing.
Next year, I think, is really going to be the year of the AI adopter. There is a lot going on into next year. We're positive, but I think there may be some volatilities.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome to Bloomberg Surveillance, ending the year with a bang. The last full trading week of 2025 stacked with economic data and rate decisions. The headline number coming tomorrow. Non-farm payrolls finally being released. Follow up later in the week by CPI. Traders, meanwhile, playing narrative roulette into next year, weighing Fed rate cuts against weak growth and AI skepticism. David Gura, once again, pulling the short straw here with us here.
Glad to
but
be
we're
here.
So glad to have you here in studio. It seems like people are trying to get a Santa rally at a time with this sort of dueling narrative of, are we going to get Fed rate cuts? Are we going to get a weakening economy? And does the AI story really turn?
Yeah, it's really been called into question. So we get this long delayed deluge of data this week. That'll be interesting. We'll see sort of how that casts a different shadow, perhaps, than what the Fed chair said at that press conference last week, his assessment of the economy, his and the other policymakers as well. But right, we saw that pivot in real time away from the enthusiasm about that rate cut and the prospects of what's going to happen next year shift almost immediately as soon as we got those Oracle results, then Broadcom. You're right, the dueling, I like the narrative roulette. It's a great term.
Well, that's what it feels like. Mike Wilson of Morgan Stanley coming out over the weekend in a note saying we are now firmly back in a good is bad, bad is good regime. Stuart Kaiser over at Citigroup is rolling his eyes and throwing things at the screen. But this is a sort of key question. Is there sort of a sweet spot where the data is just weak enough to justify another rate cut even as soon as January, but not so weak that it really undermines the idea that there will be some sort of economic recovery to start the year?
And we went into that meeting last week knowing that there was a deficit of data, that the Fed was operating somewhat blindly as it made its decision. There was that question, should they just waited till January? Was the insurance cut needed then? Yes, the good news, bad news thing I think is going to persist here going forward, but a fascinating thing for us to continue to watch and talk about.
Right now, we're trying to climb back after ending the week on a pretty soggy note for both stocks and bonds. Right now, we're seeing a tilt upward in futures, up about 0.5% on the S&P. We're looking right now at 10-year yields that are lower, taking out some of the heat after a sell-off that led the yield curve to steepen to the most going back to 2022. Right now, 4.17% rounded up in gold. Heading back toward all-time highs, the precious metal now at $4,338 an ounce, raising this question of how much more this haven bid has to go. We were talking about the week ahead, and really we have to talk about the fact we get non-farm payrolls tomorrow. On Thursday, we get CPI. We get a host of different Fed speak. Coming up this hour, we get Cameron Dawson of NewEdge Wealth with stocks looking to bounce back, Sarah Kunst of Cleo Capital on mounting AI skepticism, and Kathy Bostjancic of Nationwide looking ahead to that key week of data. We begin this hour with stocks slightly higher to kick off the last full trading week of the year. Cameron Dawson of NewEdge Wealth writing, the biggest question for 2026 is whether or not everything else can strike back and deliver the earnings growth that is necessary to unseat the narrow Mag 7 leadership. Cameron, I am so pleased to say, joins us here in studio. Cameron, great to see you. Thank you for being here.
Thank you for having me.
So this is the whole broadening out narrative. Yeah. Is it actually going to work this time?
Well, that is the really great point, is that this time of year, you always are seeing this notion that broadening out is going to be the hope trade for the next year. But the reality is that it really does depend on earnings. We looked over the last 3 years, and the Mag 7 has delivered earnings growth of 200%. You compare that to the equal weight S&P 500, it's been a whopping 16% over the last 3 years. So in order for this to actually be a sustainable broadening out of this market where leadership is not just in this narrow cohort of names, you have to see the earnings really start to deliver. What's fascinating is that if you look at earnings estimates for 2026, you can see that Mag 7 is expected to see deceleration in its revenue growth from about 22% to 17%, but equal weight is expected to accelerate from 1.5% to 5%. So there's a lot of hopes and dreams weighing on this broadening out.
Do you think that it really is predicated on the idea that the economic data is just weak enough for the Federal Reserve to cut more? I mean, really going to Mike Wilson's point of Morgan Stanley, is good news bad news, or sort of little too good, kind of bad? And a little bad, really great?
We have had the ultimate combo for risk assets in these last 2 periods where the Fed has been cutting rates. What you've seen is that as the Fed has delivered rate cuts, you've actually been raising GDP forecasts. So even though the Fed is delivering cuts, you're seeing forecasts gets ratcheted up. That's why risk assets are so happy, because when you're raising forecasts and you're getting easier policy and liquidity, of course you're celebrating. However, if you start to get data that challenges current growth forecasts, and you have 2% growth that's expected for 2026, not too high of a bar, but if data starts to challenge that growth forecast, then you're in an environment where the Fed is cutting because it should, not just because it can, and risk assets typically don't like that.
Are you of the mind that what we've seen in recent days with Broadcom, with Oracle, has kind of eroded the narrative that's buffeted the Magnificent Seven here over the last year plus? I mean, are we at a moment where there's kind of a seismic change underway, or are you kind of still looking kind of narrowly at those results and more optimistic about its continued persistence?
I think that there is now a broader questioning of how much of this supernormal growth can continue. If you look at the Mag 7 over the last 3 years, just as they delivered that 200% earnings growth, they've also expanded operating margins by a full 10 percentage points. Not 10 basis points, but 10 percentage points. And I think the question is how sustainable is that in a world where not only A, are they starting to spend a lot more money, but B, they're facing a lot more competition. Because as we're seeing all these AI narratives, whether it's TPUs versus GPUs, or it's Google's model versus OpenAI's model, all of these suggest that competition is heating up, which means that they're having to spend more money for their businesses that had been near monopolies. And that suggests that this huge run in margin expansion could come to an end.
There's supernormal growth, if I can steal your modifier there, and then there's supernormal expectations as well.
Yeah.
Is this a moment when we kind of rethink the way that we expect these companies to perform?
I think that is a fascinating question. And when we hear about this idea that 2026 is going to be the year of the AI adopter, that effectively is a veiled call for a broadening out. Because we've long been arguing that the build out of AI infrastructure is going to be a very different subset of winners than the actual application of the technology. And I think the big question is we know that AI CapEx build out will remain robust in 2026 based on current guidance, but it is going to slow down, meaning the second derivative is slowing down. And usually markets trade on second derivatives. So we could be in an environment where we look back at 25 and say maybe that was peak valuations, maybe not peak earnings, but peak valuations.
Which really goes to this sort of anxiety. What is priced in? We don't really know what is getting priced in. There was this Teneo survey over the weekend that I thought was really interesting. 400 institutional investors, 53% believe that AI initiatives are going to start paying off within the next 6 months. Then they interviewed CEOs. 84% of CEOs of large companies expect it to take significantly longer than 6 months to monetize it. There is a gap in perceptions here about the length of time, the delta between some of these investments and when you actually start to get money. Is that skepticism being priced in, or are people just closing their ears and going, la, 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 la?
Well, the thing is, what's being priced in today is not the application. It really is just this build out. And I think the big question is, can the application help fund the build out? I think it's interesting, Merriam-Webster just published their word of the year for 2026, and it's slop, which refers to the AI slop. And I think that that's interesting in a time where we're looking at OpenAI, and they have their code red, and they're saying that Sora is going to be the big source of growth, a video app, and yet people are saying it's just full of AI slop. So the question is, can we see the kind of revenue generation that's needed to continue this infrastructure build out? And if the answer is it's going to take longer than expected, do we see infrastructure build out CapEx forecasts start to come down? And that suggests then again that maybe some of this supernormal growth we've seen in the earnings starts to level off.
We'll have Mickey now with his hat cleaning out some of that slop Fantasia style, I guess, in the store. But as it broadens out, as just the prospect of it broadening out, where are you looking? Where do you see potential for that happening?
So we think that there's a lot of room to find opportunity outside of just the largest large cap growth names, meaning that you can look within things like small cap and international and value, as well as mid cap. But that's an area where we think active selection really can add a lot of value. Those indices tend to be far less concentrated. There tends to be a lot more dispersion between winners and losers. So if you're looking for a place for active management fee budgeting, that's probably the place to go.
That's fascinating to me. And we've talked a lot about small caps as well on the heels of that Fed meeting and over the course of last week, continuing to see somewhat of a upward trajectory there, continued upward trajectory. What are you thinking when you look at small caps, too?
Well, the challenge with small caps is that you've seen this continuous death by 1,000 cuts when it comes to earnings revisions. And this year is a great example of that. You came into the year expecting 40% EPS growth, and the small cap Russell 2000 index is only able to deliver 6%. So when you look at the 53% expected growth for 2026, I think it doesn't necessarily deserve the benefit of the doubt. But the big point is that small caps also had a lot of extreme outflows from positioning over the course of the summer. And you're still just about 1/5 of the size of inflows that you saw at prior peaks, such as post the election during 2021. So we think that there's still room for a chase within small caps, mostly if you're in this special environment where you're expecting an easier Fed and you're getting resilient growth. Because remember, small caps need a strong economy and lower interest rates in order to outperform.
I'm still thinking about slop being the word of the year, and that sounds about right. Cameron Dawson, you're going to be sticking with us through this entire hour, which we're very happy to say. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief. Australia's government says it will consider toughening gun laws after a father and son killed 15 people in the deadliest terror attack in the country's history. The mass shooting at a Jewish community celebration of Hanukkah on Sydney's Bondi Beach also left dozens injured. Australian Prime Minister Anthony Albanese described the attack as an act of evil anti-Semitism. We'll be watching that story throughout the morning. Meanwhile, a Hong Kong media tycoon Jimmy Lai has been found guilty of 2 counts of conspiring to collude with foreign forces after a 3rd count of sedition. Lai, a British citizen, founded and ran the now-defunct Apple Daily newspaper, one of the only Chinese-language outlets in Hong Kong that was critical of Beijing. Governments around the world have been calling for Mr. Lai's release, including President Trump. And a JetBlue flight halted its climb to avoid colliding with a U.S. Air Force tanker on Friday. According to air traffic control recordings, a pilot flying from Curacao to New York's JFK blamed the military's craft for crossing its flight path. The Air Force did not immediately respond for comment. And that is your Bloomberg Brief. Up next, maintaining Fed independence.
I think I certainly should have a role in talking to whoever the head of the Fed is.
He would have no weight. It's just his opinion matters if it's good.
Bloomberg's Tyler Kendall joins us now. And next for more. This is Bloomberg Surveillance. Trying to get the last full trading week of the year with some possible gains, maybe reprising the Santa Claus rally right now, getting an early start on that, seeing an inflection higher across the board led by the Russell 2000. So that rotation tilt, that broadening out seems to be in effect, up 0.3% on Russell 2000 futures. You got the S&P futures up 0.5%. When you take a look at the bond space, this is the why behind this. Hopes for rate cuts, hopes for that biggest global easing cycle going back to 2020, going back to the financial crisis. Looking at building on that with some rate decisions. Right now, you're building on the rally in the bond space, 3.51% on the 2-year, down a basis point. Even on the long end, although hanging in there, 30-year yield still at that 4.83%. This idea of a yield curve steepening that has steepened out to the widest going back to 2022. The real question here is the Fed in 2026, and who is going to lead it? Under surveillance this morning, maintaining Fed independence.
I think I certainly should have a role in talking to whoever the head of the Fed is. I think my voice should be heard, but I'm not going to make the decision based on that. I'll be making a decision over the next few weeks.
Would the president's voice have equal weighting to the voting members?
No, he would have no weight. It's just his opinion matters if it's good.
Here's the latest. President Trump reportedly leaning toward former Fed Governor Kevin Warsh or NEC Director Kevin Hassett, pictured there, to be the next Fed chair. Bloomberg's Tyler Kendall joins us now. Tyler, just curious to hear from your perspective how much Kevin Hassett's been trying to separate himself from the president and how the president is really navigating this race that continues forever.
Yeah, hey Lisa, good morning. Well, it appears evident that at the moment the process does remain in flux. As you mentioned, President Trump indicated in an interview with the Wall Street Journal on Friday that the two Kevins are the top two contenders. This despite the president repeatedly saying that he already has an idea of who he's going to pick. But then the president reiterated what you heard, that he would like to be consulted on the path of monetary policy. And to your question, I think it's fair to say that really in recent weeks we've heard from the NEC chair Kevin Hassett, the presumed frontrunner on this, try to emphasize the idea of central bank independence amid concerns that he's too close to the president or could cut rates too aggressively. Now, he went on in that television interview, Kevin Hassett did, to say that President Trump's voice would be one of many consulted by policymakers, but that any rate decision is going to be data dependent. He said he himself is, of course, looking forward to the delayed data that we're getting this week when it comes to jobs and inflation. But interestingly enough, he did also go on to say that he would be willing to speak to President Trump on a daily basis if he ultimately was chosen to be the Fed chair. Of course, Hassett is one of those contenders, the contender that is closest to this administration and has worked for President Trump the longest. Now, it's our understanding that Kevin Warsh had a meeting with President Trump on Wednesday, and it's not clear at this point if President Trump is going to meet with any of those other contenders. But Lisa, as you well know, this administration is really putting lower borrowing costs at the forefront at the moment of its economic agenda as it is trying to re-emphasize this idea of affordability, navigate that issue as we head into the midterms. It's worth mentioning in that Wall Street Journal interview, President Trump said that he was not sure if his economic policies were ultimately going to resonate in wins for Republicans next November.
Yeah, Tyler, just to pick up on that point, it was a really interesting one, saying that some of the money from the One Big Beautiful Bill and other stimulus plans wouldn't make their way through the economy. So his economic plan hadn't taken effect and might not before the midterm elections. Can you talk a little bit about that and kind of how he's setting up into 2026 when it really comes to policy and potential affordability issues?
Right, exactly, Lisa. It was so interesting to hear him talk about this potential delayed in money. It seemed like he was talking about the One Big Beautiful Bill. He also touted the idea that some of the investments that he's been able to get from foreign investors might not make their way into the economy soon enough, as well as tariff revenue, something that the president has really focused on. We know that this White House is trying to go on the offensive now. They're trying to put President Trump out on the trail. We had that last week in Pennsylvania, and we are expecting, according to senior administration officials, that President Trump is going to continue to hit the trail with domestic policy updates. But at the same time, the upshot here is that there is really slim margins in the House of Representatives. The numbers could change, but at the moment, Democrats only need to net 3 seats, which means that as we see these consumer sentiment numbers, which the NEC chair did say in his interview over the weekend, the administration isn't happy with where those are. As we see polling showing that Americans are frustrated right now with the economy, the issue that really sent President Trump to the White House, it is clear that this White House needs to make up some ground with American voters as we head into November.
Bloomberg's Tyler Kendall, thank you so much. As always, Cameron Dawson, a CIO of NewEdge Wealth, still with us. Cameron, how does this sort of affect what you expect for early next year if President Trump is already talking about how the money might not get to people soon enough? Is he saying something that we're not in the economic data?
Well, I think the other thing that this could throw into question is what happens with healthcare insurance premiums, which are set to jump pretty substantially. It seems like we're at an impasse as to finding resolution to keep those from jumping, which of course would further exacerbate the issues with affordability. And it doesn't seem like any of these issues are necessarily getting better. Cutting tariffs on things like coffee and bananas or beef doesn't necessarily move the needle for families that are continuing to get their belts tightened. The challenge you have is that it just doesn't show up in the aggregate data because the largest cohort of consumers just carry such a higher weight versus the weak consumers that carry a very low weight. So on the surface, things look okay, but clearly there has been distinct pain for quite some time for a lot of consumers.
You're following the ups and downs of this personnel search, as we all are, and I'm actually just genuinely curious how much you think it matters. So there have been moments when Kevin Warsh seems out, he's in, Hassett's out, he's in. Hassett saying over the course of the weekend the president wants to be consulted. Well, he talks all the time about this. It's not like the president doesn't have a forum to make his opinions on monetary policy known. When you think it through, How much does it matter if it is Kevin Hassett or Kevin Warsh? What's this going to mean in the context of committee? Because we did hear from Kevin Hassett as well, him saying what is so rightly true, that this is a vote by a committee. One person isn't going to make a whole amount of difference.
And I think that that is the exact key point, which is maybe there's this calculus going on that having somebody who has Fed experience, who has been an insider at the Fed, might have more luck getting to bend the will of the entire committee. Because it's fascinating, even as you had Hassett's name getting floated around as being the likely nominee, you weren't necessarily seeing an upward lift in yields because there seemed to be this assumption that, sure, he might want lower rates, sure, he might want to please the president by cutting rates, but that doesn't mean that everybody will vote for it. And so you didn't see yields move up. Now you're starting to see somebody like Warsh enter the picture who has been an insider at the Fed, suggesting maybe that there could be a little bit more success in bending that will.
Going back to the fog of data, the lack of data that we've had, delayed data that we've had, how much does the data that we get this week matter? Having the decision made already last week, the Fed are talking about the prospects for the economy, talking about productivity increasingly. How much do the CPI and the jobs data this week matter to you?
I think it matters a lot, mostly for the short end of the curve. If you look, the bond market only has about a 24% chance of a cut in January. So if you were to see an unemployment rate, let's say that is in the high 4.5%, that could push up that pricing for an expected cut in January, meaning that those two cuts that are priced in for next year happen sooner rather than later. But then we'll also have to contend with, on the other side, CPI. If you look at current consensus, you have headline consensus that's still expected at 3.1%. So how much of that will push the Fed's back into a corner where effectively they could still be dealing with this environment where there's upside risk to prices and downside risk to growth?
We see bad news, good news. Then.
Yeah, exactly. This is the whole thing. No, but truly, this is actually the reason why people are watching this and saying if there's a little bit of softness, that might be a good thing. I just wonder, are we missing the plot when it comes to the timing of the next Fed rate cut? We have not seen a global easing cycle of this nature outside of a recession for decades. For the Federal Reserve, it's the 1980s. For the ECB, it's never. We get rate decisions this week from the ECB, from the Bank of England. We get a potential rate hike from the Bank of Japan on Friday. How much are we looking for the same and going to get something different based on the fact that the global easing cycle is over?
Yeah, I think that we are far closer to the end than we are to the beginning of this easing cycle. And you're starting to see it in short-term rates on a global basis. No surprise that Japanese short-term rates are moving up. But if you look at German short-term rates moving up as well, and that's creating an interesting dynamic within currency markets, and likely one of the reasons why you've seen renewed downward pressure on the dollar. The dollar tried to break out in November above its 200-day and has faded. And if it breaks below 97, I think we could be talking about a DXY in the low 90s. That's important because that could have big influence on what we see as far as market leadership. Remember, you saw all the outperformance for non-U.S. stocks at the beginning of this year in the first 3 months of the year when you saw an 11% decline in the dollar. If you see renewed dollar weakness, then we could be talking about non-U.S. leadership again over a short period of time.
Is this kind of what you're anticipating as we talk about these differentials?
I think that this is another great reason as to why having a balanced equity portfolio makes a lot of sense and not being overly concentrated in one trend, one market. And of course, if we go back to that first quarter of 2025, that was the first time in a long time we got to be able to say, you're welcome for being diversified in portfolios. Because over the last few years, really the only thing that you wanted to do was just own the Qs, own NASDAQ, own tech stocks. And for a short period of time, we got this breath of, oh, it makes sense to be diversified. And if we see renewed dollar weakness, we probably see that narrative come back.
Cameron Dawson of NewEdge Wealth sticking with us for the hour. David, we are getting some information from Netflix saying that they are going to continue with their position for the Warner Brothers Discovery deal, talking about how the Paramount hostile bid was entirely expected. You're seeing Netflix shares up 0.8%. They said that they've got a solid deal in place and they don't expect anything to change.
Yeah, they're pretty resolute about it. And I think what we're seeing here is them drawing a really strong distinction between these two deals, or the deal that the Paramount would like to have. And I think what Netflix has said all along is there wouldn't be the need for the kind of cost-cutting, redundancy that you would see if Paramount were to win out over them going forward here. That obviously Netflix doesn't have a studio. There's kind of a complementarity there that you wouldn't have if Paramount were to go through with this. this. So again, looking at just the Q&As that we're seeing here today, our stance then and now is the same. We see this as a win for the entertainment industry, not the end of it. The deal is about growth. Warner Brothers brings businesses and capabilities we don't have.
Yeah, and talking about how they are committed to the theater business. So AMC, maybe a breath of relief, because this is something that certainly Hollywood was very concerned about. We'll get you more updates on that throughout the morning. Coming up next, Sarah Kunst of Cleo Capital's Oracle's AI delays reflect growing unease. You're seeing that unease in the share price as well. Plus, Yahira Anand with your morning movers. iRobot, the Roomba, it's bankrupt. This is Bloomberg. It may feel over, but it's not. It's winding to an end. This is the last full week of 2025, and right now we have a stacked deck ahead, given the fact that we get non-farm payrolls, that we get CPI. Right now, people are anticipating a strong finish, 0.5% gain on the S&P. You are seeing that sort of 117 level on the euro dollar just stay around there. It really has been quiet in the FX space, and you do see a slight rally into the long end of the yield curve. Watch this space after that yield curve steepening that we saw last week, 416 on the 10-year. Gold going back toward an all-time high, up almost 1%. Really, this has been the stalwart. What's gold saying? That's what a lot of people are going to say. What's Yahira Anand saying? 3 hours away from the cash open. Here are your morning movers with Yahira. Yahira.
Hi, Lisa. Well, tech is starting the week on a better note, and NVIDIA is leading the charge. We are seeing shares up 1.2% after a more than 3% drop on Friday when doubts around the AI trade started to swirl, partly due to that Oracle story that we reported that it was delaying some of its data centers for OpenAI, and of course Broadcom's results failing to impress investors. Meanwhile, we move on to some M&A chatter with Intel. Sources telling us that Intel is in advanced talks to buy AI chip startup SambaNova for $1.6 billion, well below the $5 billion valuation it was given back in 2021. Investors are reacting positively to the deal, not just because it is a bargain, but also because it provides a platform for Intel to compete with NVIDIA's AI chips. Sources telling us that a deal could close as soon as next month. And we end on the Roomba maker. As you said, iRobot plunging more than 80% after it filed for Chapter 11 bankruptcy, with plans to go private after it hands over the reins to its main Chinese supplier. Of course, its autonomous vacuum cleaners were all the rage at one point, but it's failed to keep up as cheaper alternatives have hit the market. Lisa?
Thank you so much, Yahira. I just want to point back to Netflix and Warner Brothers. Netflix coming out with a filing earlier this morning, just moments ago, saying that their bid for Warner Brothers has not changed in any way, saying that the bid from Paramount was entirely expected, but they have a solid deal in place. They continue to reiterate the benefits for the consumer, and those shares up 0.7%.
Fascinating to watch. I mean, this is going to be a saga that's going to last a long time. I know we're up against this deadline when Warner Brothers has to decide whether or not to take the the Netflix offer. But I think that we're going to see this back and forth, and that was kind of indicated before this deal was announced. You saw Paramount sending a letter from its legal team to Warner Brothers saying it didn't feel like it had a fair shake in the introductory part of this. But I think this is going to be a story that plays out over many months. And again, I think that distinction between these two deals will come kind of in starker relief as it goes along. But we'll keep looking for more filings like this one.
Yeah, and it comes as global transaction volumes has risen 40% so far this year from the prior year. On our radar this morning, NEC Director Kevin Hassett saying he would listen to President Donald Trump's advice if he made a Fed chair. However, Hassett stressing that the Fed's interest rate decisions will remain independent. Meanwhile, Ukraine President Volodymyr Zelensky considering security guarantees from the United States and Europe in place of its long-term goal of joining NATO. Ukraine has sought membership for years, but has altered its rhetoric as Washington presses for the war to end. And this story catching our eye, China's economic recovery hitting a wall, retail sales rising at the slowest pace on record outside of the COVID-19 pandemic. And fixed asset investment is on track for its first annual drop since 1998. Cameron Dawson, to me, this sort of raises this issue of, are we seeing a reacceleration of China that some people were talking about and betting on? Or is this something different?
I think that this could challenge the broader pro-cyclical narrative that has taken over markets over the last couple of months. You've seen a lot of movement in things like industrial commodities, which we typically see are very related to the Chinese market, given that it's been a very infrastructure-focused economy. And so you've seen some perkiness in those prices. However, if you start to see China not deliver on growth, does that suggest that you see more weakness kind of start to set set in. The real big question, though, is that if there is a lot of weakness within the Chinese economy, that usually causes people to say, ooh, we're going to get more stimulus, and thus we can be bullish after all.
Well, this has sort of been the story for a long time, but right now it seems like for investors, they're looking at whether Chinese tech can really beat out the United States. And that is the big bet right now in China, because ultimately, as we see in the United States, the actual economy can fall off a cliff, but you can still see tech sort of fill in the blanks.
Yeah, and Chinese tech on the Golden Dragon Index peaked back at the beginning of October and has been trading pretty heavy ever since, not keeping up with U.S. tech shares. So the trend doesn't look all too inspiring. We'd watch the technicals really closely for a sign that this breakout could actually be sustained.
Let's stick with tech. NASDAQ futures bouncing back after Oracle announced plans to delay AI data centers, and that led to a pretty huge sell-off in the prior week. Joining us now is Matt Bloxham of Bloomberg Intelligence. Matt, just how serious are some of these delays, and how different is the likes of Oracle and OpenAI from the behemoths of NVIDIA and Microsoft?
Yeah, I mean, they're obviously significant, but I think in terms of their ability to kind of honor near-term commitments, that there's no risk there, and I think they made that clear in some of their statements. But I think what it does go to show are the huge bottlenecks in the development of these big new data centers needed to kind of support the demand for AI and more broadly cloud computing. And we've heard comments like this from the likes of Microsoft, who said that they would be recognizing more revenue if they could. They just can't bring enough capacity on stream quick enough. And I think what we're seeing here with Oracle is essentially reprioritizing their finances, but also the resources and raw materials they can get hold of into the data centers that they need to bring on stream sooner to kind of deliver on those commitments, mainly to OpenAI. There's so many people building data centers that the human manpower you need to build them and design them, the power, all of the electrical components that go into creating these data centers is in really short supply.
Matt, Oracle is certainly having its day or week in the sun here. I'm curious how much you look at it as a proxy. So Lisa mentioning some of those other names, but when you look at the kind of bottleneck you're describing, is it something widely shared by its competitors, or does it stand kind of alone in that regard?
No, it's very much an issue we see shared across competitors. As I mentioned, Microsoft in particular has kind of called out the challenges they face in bringing enough capacity on stream. So it's an industry-wide issue. That's not to say that we aren't seeing huge construction take place. We really are, but it's taking place across so many big players with big budgets that this is really stretching the capacity of the data center ecosystem beyond anything that we've seen before ever.
Matt Bloxham of Bloomberg Intelligence, thank you so much for those insights. Sarah Kunst of Cleo Capital writing, Oracle's core business just isn't going to grow as fast or as cheaply as people wish. Oracle is a solid cloud company. It's much less clear that it's an AI data center darling. Sarah joins us now as we parse through expectations versus reality. Sarah, so thank you so much for being with us. I want to just start there. I mean, how much of the froth has already come out of the likes of Oracle with a 40% decline in that name since its peak this year?
Absolutely. I think that the reality is that they jumped into this trend a little bit late. They saw a massive spike up. And now people are realizing that the financials don't quite work as well as we had hoped. And so I think that there is some sort of locking in gains and saying maybe this isn't going to go to the moon.
Well, this raises a question. Who is actually doing a good job right now of managing expectations while continuing to be the darling of the data center and AI world? On one hand, you could say NVIDIA. On the other hand, you could say they had a $5 trillion valuation. There are questions about competition. Is it Meta? Is it Microsoft? Is it, for example, what we see with Amazon and some of the new chips? Where is your eye sort of set?
So I have been saying this from the very beginning. I think it's Alphabet. When you look at what sort of catalyzed this AI trend, it was OpenAI. But the researchers at OpenAI were all mostly Google alums who had been there writing that initial paper. I think it's called Attention is All You Need, that really kickstarted this sort of generative AI boom. And most of them have left OpenAI, but Google certainly has an insane amount of talent with its DeepMind team. Gemini's baked in. There's clear revenue streams there. They can make money on the advertising. They have the capacity around data centers. They can do interesting things with chips. We know that because of their work with stuff like Waymo. I think that Google's the winner here. I have been saying that forever while everybody else on the street was saying, Google's missing the boat on AI. And the reality is, I think that they are so far out ahead of the current.
Sarah, if we continue to see some weakness in some of the Mag 7 names like Meta, do you expect that we could see them start to turn to a little bit more discipline in their spending, kind of akin to what we saw back in 2022, where if the share prices continue to come under pressure, they may not be able to spend quite as much?
Oh my God, you have to be so mean to Zuck to get him to rein in his spending. You really, really, really have to make that man look at the stock price quarter over quarter over quarter before he starts to say, maybe they don't like what I'm doing. And I think the difference this time with that sort of legless metaverse thing that he was on a few years ago before that year of austerity is that the market does like AI. The market cooled on the metaverse very quickly. It's not going to cool on AI in the same way. And so I think that you will continue to see Meta spend. I think the question is who they spend it on. Is it a good idea to let Jan LeCun go? Is it a good idea to have Alexander Wang in that role instead? We know that there's a lot of tension inside of those teams. How much work are they really getting done while they're getting paid up to $1 billion a year? So those, I think, are the kinds of questions that are going to be top of mind for Zuck much faster than should I give up AI altogether?
In fairness, we did see Mark Zuckerberg have some rethinking of the metaverse. It seems like at his Hawaiian retreat when he decided to make some cuts to Meta over the course of Meta staff over the course of the last few weeks. Bearing that in mind, I'm curious what level of introspection you think is happening in this sector broadly. So we've talked a lot about kind of the capital investments, how much of that is being paid for by debt now. Are we at a moment in this story where there is kind of a more general re-examination of the way all of this is proceeding?
Look, they're all still the richest men in the world. I don't think that losing like 2 pieces of gold on your Scrooge McDuck pile makes you fundamentally rethink your life's work. I do think, though, that there are real questions about the cost of doing AI. When you look at things like OpenAI, Sora, I've seen estimates that say that it can cost up to $5 to make a 15-second video clip that they are giving to people largely for free. Where do you get the ROI on that? And that's true across the category, across the sector. So there's so much money being moved around everywhere except from customers' wallets to these companies. And I do think that next year, the big question is going to be, could we get somebody to pay us for this, please?
Sarah, just real quickly here, how much are you seeing upstarts really come with great ideas that you think could be successful in this environment? Or are some of the largest companies really consolidating talent and market share in a way that really prohibits some of these smaller companies from getting in?
I think it's a little bit of both. Smaller is a funny question to ask when you have people like the OpenAI team, like Ilya, leaving and immediately being able to raise at multi-billion-dollar valuations with multi-hundred-million-dollar seed rounds. That's the new small. But we certainly see a lot of that. There's a tremendous amount of talent globally in the AI space. And so I do think that we will see, I have names like Grok with a Q, the Elon Musk one, that have done incredibly, incredibly well. So, I think that there are good startups here. It's just a question of, is the private market going to continue to be interested in funding them before we really see the revenue come online across any of these?
Sarah Kunst of Cleo Capital, thank you so much for being with us this morning. Cameron, what do you make of that? This idea that really it is Google, the others kind of, Zuck, you have to just be really mean to in order for him to do anything like ratchet back his spending.
Yeah, I remember the hoopla when all of a sudden he goes, "There's pants in the metaverse. We now have pants." This all comes down to the returns that they're going to see on all of this spending, and I think it'll be fascinating on Sarah's last point as to what happens if we start to see them push into public markets. Could we see an IPO of one of these AI darlings in 2026? I know it's not AI, but SpaceX is talking about potentially doing an IPO. You've seen a little bit of a heavier trading activity in the IPO ETF, which is a great barometer for how the market is willing to accept new issuance. So let's see if we can get one of these mega deals out onto the street in public markets, and if that could open the door for more capital raises from public markets for AI companies.
Yeah, David, what was it? $800 billion, I think, for SpaceX?
That's what I saw. Yeah. But picking up on this point that she was making about who's going to pay for all of this, I do think this distinction between who's working on enterprise AI versus consumer-facing AI is going to be fascinating to watch going forward here as well. Obviously, OpenAI is doing both, but kind of betting on the consumer-facing side. But you have Anthropic and others, Google certainly among them, really making the case that that's where all of this is really going to manifest itself in progress and improvements in our day-to-day lives. It can be used for medical research or making our jobs more efficient. I think that'll be a very fascinating thing to watch going forward here.
How much will you pay to ask ChatGPT, why does my elbow hurt? I mean, that will be the sort of key question. Right now, let's discuss less of that, more of this. An update on stories elsewhere this morning. Here is your Bloomberg Brief. President Trump is suggesting the U.S. will do, quote, big damage to militants behind a deadly attack on American forces in Syria. 2 soldiers and an interpreter were killed over the weekend during counterterrorism operations. Trump is blaming the assault on the Islamic State terror group. Meanwhile, Brown University has sent students home and called off final exams for the fall semester after a shooting killed 2 students and injured 9. The shooting occurred on Saturday in an engineering building, prompting a shelter-in-place order that was later lifted a day later. A person of interest was detained yesterday, but he was later released. And Hollywood director and actor Rob Reiner and his wife were both found dead inside their Los Angeles home this weekend. The couple reportedly died from stab wounds. Reiner, a well-known activist who contributed to liberal and democratic causes, was 78. His wife, Michelle, a singer, was 68. And he was, of course, the director of movies like The Princess Bride, as well as When Harry Met Sally. And that is your Bloomberg Brief. Up next, watching for cracks in the data.
We might be starting to get the data that really starts confirming, whoa, something's not quite working. Now we're at that proof is in the pudding, and I'm a little bit nervous that the jobs data is going to show this is not working the way we hoped it would be.
Kathy Bostjancic of Nationwide joins next from New York. This is Bloomberg Surveillance. We're trying this again to end the year, possibly getting that Santa rally and potentially building on gains that we've seen earlier this month. Right now, you are seeing about a 0.5% lift to S&P futures. You see sort of a somnolent kind of move in the currency space. Honestly, it has been almost entirely flat between 116 and 117 on the euro-dollar cross, and 10-year yields now in a complete 2 basis points at 4.16%. Gold. Watch this space as the precious metal climbs back toward all-time highs. People saying maybe it got over its skis. Well, maybe it's getting back there after a rip-roaring rally this year. Under surveillance this morning, watching for cracks in the data.
We might be starting to get the data that really starts confirming, whoa, something's not quite working. Now we're at that proof is in the pudding, and I'm a little bit nervous that the jobs data is going to show this is not working the way we hoped it would be. People aren't comfortable leaving their jobs. That tells you everyone knows the job market's a little bit sketchier than maybe the data shows. There's a risk that this data comes in much weaker than we're expecting. I'm definitely not quite sanguine about the economy. I think there are some risks there.
Here's the latest. Traders bracing for the final data points of the year and looking for clues on the Fed's path forward. Kathy Bostjancic of Nationwide writing this. We expect a long pause until June, allowing time for inflation to peak and start trending lower and coinciding with the end of Chair Powell's term. Kathy joins us now. Kathy, before we get into the discussion around the Fed, let's talk about the actual economy. How weak is weak when we get non-farm payrolls tomorrow?
Well, good morning, Lisa. So we're expecting, soft reading, up 25,000 overall. Now that's for the month of November. We will get October and November, but I think the focus really goes to November. And for, the household survey, which gives us the unemployment rate, Chair Powell's already warned us that it's going to probably be distorted. They really didn't have the normal time and process to collect data. So I think you pay a little bit of grain of salt to the household survey, the unemployment rate. But payrolls we think are weak, and we think the risk is on the downside, especially since government workers are going to be rolling off severance. That could really drive the number even to a lower level.
Peter, you're talking about the sketchiness of the jobs market. Let me ask you more about the sketchiness of these data. So you're getting at what I'm very curious about, which is low quality data coming out of this government shutdown, the challenge of sort of getting a good read on the labor market, given what Chair Powell said at that press conference about how accurate this data might be, what might be counted, what might not be. Talk a bit about that, the veracity of this data, the importance of this data, given what we know are kind of deficits of it.
Yeah, no, all concerns and great question. My sense is the payroll data will be more reliable. Really, they can reach out to establishments, companies, get that data. It's not as difficult of a task. In fact, you can make the argument maybe it's even a bit more accurate because they had more time. Remember, a lot of the companies are slow to respond in the first, when they survey for the month, and then the revisions catch a bigger swath of the data. The household survey is a different story because you actually have people calling, households and asking them, are they looking for a job? Are they employed? And things like that. That wasn't really done completely. And I think that's where, Chair Powell's warning us, don't pay too much attention to the unemployment rate. I think once we get the December data, we'll get a better reading. But I think the payroll data has such a wealth of information. We'll get wages, hours worked, breakdown of where employment is. I think that is enough to kind of satisfy us for now, especially since we've had such a drought of data.
You heard Peter say that he's not sanguine about the course of the economy. I'm curious how you reacted to the tone and tenor of what the Fed chair said on Wednesday of last week. I won't say that he had a rosy outlook for the economy. When it came to growth, for instance, he did seem to be more positive than he had been in the past. What did you make of that? The way that he engaged with prospects for growth, the way that he talked about productivity, for instance, just the way that he's approaching this U.S. economy in the tail end of his tenure.
Yeah, I do think he was, rather optimistic. One, he's coming to the end of his term, so he wants, as he said, his legacy is he wants to hand off a good economy, solid economy, and lower inflation. And that's essentially what the Fed's forecasts are. They do line up with ours, too. I would say that we are, on the optimistic side that growth will improve, we'll get more balanced growth next year. But some of that is coming from fiscal policy. We're going to get quite a bit of stimulus starting in the first quarter. Tax refunds could be, $50 billion. And then additional business incentives that are baked into the One Big Beautiful Bill. Plus the Fed has eased rates. That starts to work through the system a bit as well. And I think we get past this peak uncertainty, right? We know that not just the tariffs, immigration changes, but the uncertainty around that really weighed on economic activity. I think we get past that next year and things start to loosen up. The risk is the labor market, though. So there you could see a little bit of weakness persisting. But I think those refund checks do help to boost consumer spending.
Kathy, how do you expect inflation to progress in 2026 as we think about things like wages and rents? Do you think that there could be a downside surprise potential to inflation as we move through the year?
Well, good morning, Cameron. Great question. So, yes, we do see housing inflation, so that's rents, to continue to trend lower. And we think other services, inflation is on a downward path. We do look for goods prices to continue to edge a bit higher. The tariff impact, I think, is still going to feed through. But we see that peaking, somewhere around, the start of the second quarter. So again, not too different from what the Fed and Chair Powell painted. We think it peaks and starts to trend lower. We just think overall the tariff impact has been more moderate. And you do get that disinflation for the service side, which is really, if you think about it, that comprises the largest share of measured prices.
Kathy Bostjancic of Nationwide, thank you so much for being with us. Cameron, I turn this to you. Do you think that right now the CPI report or non-farm payrolls is more important this week?
Well, I think non-farm payrolls is far more important for the Fed because they have told us that they will look through any kind of stickiness within CPI on the good side of things because of tariffs being considered not transitory, but a one-time impact.
Transitory.
Transitory. Yeah. So, but I think the important thing on inflation is that if we look at those big components, as Kathy was mentioning, you're still seeing wages look like they're pointing lower. Look at the quits rate that typically leads wages. You have continued downward pressure in observable rents, which suggests that shelter component is moving lower. So certainly that could help.
Cameron Dawson of NewEdge Wealth, thank you so much, as always, for being with us. Coming up next hour, Sarah Hunt of Alpine, Sachs & Woods, Henrietta Treyz of Veda Partners, Jayati, Bharadwaj of TD Securities, and Russ Koesterich of Blackrock as we see markets melt up to close the last full trading week of 2025. This is Bloomberg Surveillance.
The Fed is not not going to solve the labor market.
This concern that the Fed has about the weakness in the labor market, I think it's a bit overdone.
The Fed is well aware of the fact that inflation remains a very sizable problem.
There's certainly a risk here that you could see inflation that's a bit more sticky.
Economic surprises keeps us in this scenario.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. A busy end to the year with traders preparing for a stacked week of economic data and policy decisions, with markets searching for that holiday melt-up as investors shake off AI skepticism and growth fears. The focus now turning very much to the delayed non-farm payrolls report out tomorrow. David Gura here alongside me, and there really is this question. Are we looking at a labor market that's softening just enough to keep the Fed in play, to keep that bullish spirit going?
What's good is bad, what's bad is good, to quote Mike Wilson, or to borrow a phrase from him going forward here. No, I think it's a fascinating thing to watch. We get this data. It's been long delayed. Tomorrow, CPI data coming this week as well. We'll talk about the relative quality of that, but I think it'll be interesting. We'll put that Fed meeting in a new relief once it happens.
Yeah, and watch that unemployment rate that we get tomorrow as well. We also get CPI that comes out on Thursday. We also get a smattering of Fed speak, whether it's Chris Waller, whether it's John Williams, whether it's Bostjancic. We get some earnings. And then, of course, we get all of these policy decisions from the ECB, from the Bank of England, from the Riksbank, from the Norges Bank. And it raises the question, have we seen the end of the global easing cycle? And are we entering something different as the Bank of Japan potentially on deck to hike rates?
There's that. There's the AI story, of course. You say investors are shaking it off. I candidly wonder if maybe they're postponing sort of the apprehension or pessimism they might have to the new year. Want to end this week, this full trading week, with the bang going into the holiday season. Again, I do think we're at this kind of very fascinating moment here, perhaps more fascinating than a lot of investors thought. The tail end of December going into January.
Well, this year has been one of roller coasters, has been one of narrative roulette, has been one of tosses.
Pick your metaphor.
Pick your metaphor. It has been it. It has been a long year, and we are entering the final stretch, and we're entering it with a positive tone. Right now, you're seeing S&P futures up about 0.5% as people look to possibly a brighter future, as you were talking about. We also get some earnings from the Lerner and Nike and FedEx. We also have a currency space. Watch this sort of dollar weakening trend that we had been seeing that seems to be reasserting itself slowly as the euro climbs just a bit against the dollar, 117.50. 10-year yields actually getting a bit of a bid and now in through 416, 4.1587%. And gold, after more than a 65% rally on gold, you are seeing an inflection higher of more than 1% in early trading. Coming up this hour, Sarah Hunt of Alpine Sachs & Woods as Wall Street shakes off some AI alarm. Henrietta Treyz of Veda Partners as President Trump's approval rating slides. And Russ Koesterich of Blackrock as bond investors eye key economic data. We begin this hour with stocks trading near record highs once again after Friday's AI pullback. Sarah Hunt of Alpine Sachs & Woods writing, "We think this illustrates a level of concern from investors that there is too much spending on the horizon and not enough cash flow to fund it." Sarah joins us now for more. Sarah, wonderful to see you. Thank you for being here.
Good morning. It's great to be here.
So is it enough fear? Is it enough skepticism to make you actually interested in AI once again, or does it need to go a little bit further?
Well, it certainly seemed like enough last week. I mean, there were some big moves last week, and I don't think the market, I mean, you look at Broadcom's earnings, and the numbers themselves were very good. It's back to the expectations problem and the second derivative problem, which Cameron just mentioned, which is what happens when you're still spending a lot of money, but you're not spending it quite as fast as you were. And the more you spend, the bigger that the problem of large numbers comes in. And can I go 10% on every 10% or 20% every year? And I think that's an issue. And now people are starting to question, where's that money coming from? And that question didn't happen in the beginning. And you've got some real issues with companies that used to be cash rich now getting more asset heavy. And I think that's a little bit of an absorption issue for investors right now.
But have we gone a little too far with this, with the idea that Microsoft and Google really are going to face some sort of insolvency risk or some sort of serious existential question because they're borrowing a bit from the bond market, right? I mean, have we sort of thrown the baby out with the bathwater, to use John Solfis's term, given the fact that people seem skeptical more broadly of the promise that they embraced 2 weeks ago?
I think that is just indicative of what we've been living with for the last several years out of the pandemic, which is narrative shifts every day. And yes, the pessimism gets wildly bad and then it gets wildly fantastic again. And this is why I wouldn't say that this is a moment where you have to go, oh my goodness, we have to change everything. But you have to think about who else might benefit and how that's going to go. And I actually think that even the story about the CDS for Oracle, I think that's much more about hedging the stock than it is about actually thinking that Oracle's not going to pay its bonds back in the end. So I think a lot of this is the mechanics of how that spend is going to come about. And I don't think it's really challenging the fact that money is going to get spent.
I don't want to say that groupthink is great, but I want to pick up on what you just said there, which is we have all of these narrative shifts, dueling narratives. What does that say to you just about conviction, investors' conviction in this, not just this trade, but in the prospects of AI generally?
It is difficult to have because it's hard. I mean, the conviction that AI is going to be a big thing, it's going to make a lot of changes, I think hasn't changed. What those changes are going to be, who is going to benefit from those changes, and how fast they're going to be implemented seems to be a big part of the current concern. It was easier to say at the beginning of the year, we see a ton of spending on infrastructure. There's still going to be a ton of spending on infrastructure, but now that that's getting questioned, is that the peak of infrastructure spend discussion? Now do we have to look at use cases and who's using it and how they're using it, and is this going to improve margins? Because in the end, that's what it all comes down to, is it going to make people more money? Because if it isn't, then it isn't going to raise earnings, then it's less exciting than if it is going to raise earnings.
It's December. I'm in a retrospective mood. Perhaps you are as well. You mentioned that question wasn't being asked at the beginning, which was how is all this going to be paid for? Is it going to be cash? Is it going to be debt? What do you make of that in hindsight now, the fact that people weren't wrestling with those questions to begin with?
I think with every big investing enthusiasm, there is a willingness to suspend belief about whether or not and how things have to happen to get to the point where everyone's excited about. And I think that it doesn't mean that we won't suspend that disbelief again, right? So there's going to be some technological changes. I don't see how you get the molecules and the electrons to as many data centers as we have. So I think that there will be changes, and those changes are going to occur in ways that are right now difficult to parse. So you don't know who's going to win and who's going to lose there. I think it was very clear at the infrastructure beginning who was the winners, and now it's like, okay, who's going to win now? And are the winners really over, or is that just something that isn't going to grow as fast?
Yeah, the conversation over the weekend was you almost need bubbles to fuel technological advancement. I mean, I know that sounds really strange and perverse, but there is a sort of element of you need that enthusiasm to finance absolutely everything. Is there sort of this feeling that you need to see the broadening out in the trade, the idea that other companies benefit from AI to keep the AI machine chugging, right? That in order for people to justify valuations where they are in the big tech giants, you need to see participation on a broader scale.
I think you absolutely need to see that participation. And I think that was a question even earlier in this year, in the beginning, at the end of last year, which was who's going to use this? And then Walmart came out and said a few things about how it was helpful for margins. And other companies came out and said, yes, we can use it this way, and it's going to be, and that sort of solved the short-term problem. But longer term, that has to broaden out. And that has to be, and this is also the question about small caps. Can they use this to make some margin improvements? Because the small cap earnings revolution was supposed to happen 2 years ago, and then last year, and then this year. And is that really going to come through? And I think all of those things are very important as we go forward. And where valuations are right now, it's even more important.
This is where the economy starts to matter again. This is where all of a sudden, when we were talking about how anything related to AI could be in its own universe and the economy could keep sort of dragging along and basically being in a recession if it weren't for that AI investment, at what point can you see this expansion, this broadening out, unless you see economic data like what we're going to be getting this week really pick up?
It's interesting because I think that the government shutdown has not only made the data that's current difficult to see what happened just recently, but it also may have shifted some activity into next year. So it's going to be interesting to see that. You do have to see an economy that keeps chugging along. If it doesn't, you're going to have a problem. There's no question that that's going to be an issue. That's an issue for earnings. Earnings lead to valuations. And that's the circle that investors are looking at.
Speaking of circles, let's talk about circular investment and your sort of thoughts on that right now. I mean, we can't have this conversation about AI without going back to that. And I'm curious how worrisome that is to you. Have your worries been significantly or sufficiently assuaged by these companies saying that it's not a big deal?
I'm not sure that I can say one way or the other it's definitely not a big deal or it's a huge big deal. I know that in 2000 there were a lot of issues with vendor financing. It was quite simple, right? The companies were selling stuff and they were financing it.
Can we say circular deals and vendor financing are the same thing?
I don't think that you can, because I think that there are some of the players in that circle have much more cash than they did before. So last time it was vendors financing who didn't have the cash to companies who didn't have the cash. Now there is cash in the mix, and there's quite a bit of cash. And that's where you're seeing the have and have-nots on the tech side of who's cash rich and who's not, and who are people concerned about whether or not they're going to raise money or not. Again, I don't think that Oracle, anyone's concerned that it's going to go bankrupt, but I think that there are concerns about overburdening balance sheets right now.
Lisa brought us to the economy. Let me go back to that. Sorry to pull us away from that there just for a moment. But I'm curious, how do you think about growth in the year ahead? Are you, to borrow a phrase from Peter Schiff, not sanguine about it, or are you feeling like prospects are good, things are going in the right direction?
I think it's tough because the K-shaped economy is a real thing. The people who are spending the most money are the people who have the most money. The lower end consumer is not doing well. A lot of the companies that track that are not doing well. And I think it's going to be, that's really a question now, how much have we overstated jobs, right? So in Powell's conference, he talked about some of those overstatements, and maybe instead of generating jobs, we're losing jobs every month. How much is that really occurring? What can we see? And what do wages look like? Because all of those things matter. It's great that the high end can spend, but you really need, for the full economy to chug along, you need broader participation.
Yeah, which is the reason why everyone's watching and hoping for this broader participation in the equity space. Sarah Hunt of Alpine Saxon Woods is with us for the hour, I'm so pleased to say. And honestly, this is part of the reason why people are saying you're seeing mergers and acquisitions and things of that nature, because there is this broadening out. We just saw a 40% increase in transactions and announcements for global M&A, and people expect that only to continue.
And we were talking a little bit about with Cameron in the last hour, just that sense that this might be a moment for IPOs that we haven't had in a while. So yes, M&As and I think public offerings as well.
Yeah, meanwhile, right now, let's get you an update on stories elsewhere. Here is your Bloomberg brief. National Economic Council head Kevin Hassett saying he'd consider President Donald Trump's policy opinions if picked to lead the Federal Reserve. Hassett was responding to questions about Trump's comment on Friday that he should be able to make recommendations on rates set by the Fed. Hassett is one of the frontrunners to replace Jay Powell as Fed chair next year. Elsewhere, talking about IPOs, SpaceX starting the process of selecting bankers for its IPO. The Wall Street Journal is reporting that investment banks are scheduled to make their initial pitches this coming week in what is known as a bake-off. SpaceX's CFO reportedly told staff that whether a listing will happen and when it might take place remain highly uncertain. An $800 billion bake-off. Meanwhile, Zootopia 2 is officially the highest-grossing Hollywood release of the year. Disney's animal-packed animated sequel made $1.13 billion globally after 20 days in the theater, overtaking the haul of Disney's live-action Lilo & Stitch. It is the 7th biggest animated film in history and I'm just suggesting, may have gotten a boost from the fact that it was really cold out. I mean, I'm just saying.
Have you seen it? You haven't seen it.
I haven't seen it. Have you seen it?
No,
I mean, but
sure I
you
will.
think about it. I mean, if the kids were a little bit younger, I mean, I think that you'd be looking for activities. I think it would be great. Meanwhile, up next, the conflicted consumer.
Consumer sentiment right now is lower than anyone would like. People look at their wallets and see they're doing better, which is why we have the biggest Black Friday ever and so on. The sentiment will catch up with the reality.
Henrietta Treyz of Veda Partners joins next. This is Bloomberg Surveillance. A reprisal, perhaps, of that rotation that we had been seeing in the past couple of weeks. Today, the Russell 2000 is the outperformance, although off some of the earlier highs, up almost 0.7% on the futures. Right now, S&P futures up a little less than 0.5%. Similar kind of move on the NASDAQ. The why behind this potentially is the everything melt-up rally that includes the participation of the bond space. 2s, 10s, and 30s. You are seeing yields lower as people look to economic data throughout the week. The potential for the Fed to cut maybe even as soon as January. 3.5% on the 2-year. You have seen that steady drip with expectations for Fed rate cuts high. On the long end, less so. Yes, you are seeing about a 2 basis point decline, but that yield curve steepening very much reasserting itself with 30-year yields back at 4.83%. Meanwhile, gold, check this out, climbing back to all-time highs so far this year. More than a 65% rally in the precious metal and continuing to climb back toward all-time highs. Is this because of dollar debasement? Is this because of haven fears in the face of growth concerns? Something to debate for the ongoing future. And frankly, under surveillance this morning, it is the conflicted consumer.
Consumer sentiment right now is lower than anyone would like. But, we find that very often happens during a government shutdown. People look at their wallets and see they're doing better, which is why we have the biggest Black Friday ever and so on. The sentiment will catch up with the reality. The money that we're talking about is like real money. So for groceries, it went from $400 a month to $525 a month under Biden. So that's like an extra more than $1,000 a year you have to spend on groceries.
Here's the latest. President Trump telling the Wall Street Journal he's unsure his economic policies will lead to midterm wins. An NBC News poll showing the president's approval rating down to 42% as economic concerns weigh on Americans. Bloomberg's Tyler Kendall joins us now for more. Tyler, can you talk a little bit about the evolution of President Trump's approach when it comes to talking about affordability?
Yeah, hey Lisa, good morning. Well, we have to keep in mind that it was really a slew of election losses for Republicans in November that put this White House on the defense when it comes to higher costs of living, as the polling and the data has repeatedly shown that these concerns are really resonating with voters. And we've seen President Trump sort of evolve on the issue. At first, he was calling affordability a Democratic hoax, and he has been touting his policy proposals. But now he's saying that it's going to take a little bit more time for them to work through the economy. As we've heard, some of his advisors mirror these same sentiment points as well. You heard the NEC director, Kevin Hassett, there talk about consumer sentiment, which, yes, while slightly improved, is still hovering near record lows as some consumers have pulled back, while others, particularly higher income households, continue to power the economy. I also think it's worth mentioning in that NBC poll, we're seeing President Trump's support erode among Republicans, too. This is a bipartisan issue, and the White House is really going to start to feel the pressure even more when it comes to the issue of health care, because it appears very likely that we are going over the so-called Obamacare cliff. Lisa, the House of Representatives is set to vote on a health care package this week after the Senate failed to advance any legislation last week, but it does not address those expiring Affordable Care Act premium tax subsidies that could see millions of Americans face higher premiums. And at this point, even if that does pass the House, it doesn't seem likely that it's going to pass the Senate because there is only 1 week left in the legislative session for this year. And then lawmakers are heading out of town for the holidays, and they're not expected back here in Washington until at least January 5th.
Tyler, what is the president's plan, or the plan for the president, maybe is a better way of putting it? We saw him go to Pennsylvania last week, deliver this big speech, talk about affordability among other economic issues. Are we going to see more events like that? Is he comfortable talking about this? Is he under pressure to talk about it more? How does he engage with this issue of affordability in the economy running up to the midterms?
Well, he's definitely under pressure to talk about it more. In fact, we heard from President Trump, David, on the campaign trail in Pennsylvania last week, saying that his chief of staff, Susie Wiles, has told him that he's going to be making a lot more of these appearances. We know that he's very comfortable on the campaign trail, but while that speech last week, our understanding was expected to be focused solely on the economy, we also heard him veer into some of those other topics that do well with his base, including immigration. We spoke last week about him talking about the auto pen and potentially even looking into how that impacts Federal Reserve nominees. So it's going to be a issue for this administration that's going to keep coming up as his policy officials want to keep him on topic when it comes to the economy and urge voters to have some more patience when it comes to their policies. And David, I'll quickly mention that we continue to hear this White House put out new policy proposals. For example, last week, President Trump touting new investigations into the food supply chain, aid for farmers, and of course, one of those big ones that he keeps touting but would need Congress's approval, the potential for any tariff rebate revenue checks.
Tyler Kendall, thank you so much, as always, for that. Henrietta Treyz of Veda Partners joins us now for more. Henrietta, how do you sort of view this interview in the Wall Street Journal in particular with President Trump, where he's saying that people just haven't felt the ramifications or the benefits from some of his policies? Will that actually make any headway early 2026?
Yeah, that's absolutely true. The One Big Beautiful Bill went into effect immediately for corporations. Indeed, we've seen that corporate tax revenue has dropped by about a third into federal coffers this year. That's because of the tax preferences that went out very quickly after they passed that bill on the corporate side. But the individual side is back end loaded and starts in the new year when the tax filing season starts. So when you think about the odds of a reconciliation bill 2.0, for example, or the $2,000 tariff rebate checks, for example, that requires another act of Congress. And as far as the White House is thinking about it, and indeed, when I talk to Republican staff on the House and Senate side, they're saying, we already did the individual tax cuts, you just haven't seen them yet. So when Kevin Hassett comes out and says 2026 is going to be a boon year for the consumer and individuals, it's because the tax preferences that hit the individual side of the docket really start in the new year. So if you are, really looking forward to the SALT deduction, that's coming for you. There's a really small segment of the economy that's on the no taxes on tips, no taxes on overtime piece. That all starts in the new year. And they're hoping that that's going to be enough to overcome the continued hit of tariffs, the continued negative narrative around affordability and the high cost of living, housing, healthcare going up by $1,000, et cetera. We'll see.
Henrietta, as you talk to staffers on the Hill, I'm curious what they want this president to be doing. So you lay out very clearly sort of the benefits that'll be very evident, I imagine, to the American public here come in the new year. What do they make of his emphasis on immigration, on foreign policy, him not talking about affordability? What would they like him to be doing more, and what's the reaction to him not doing more on that front?
It's a real mixed bag with the same answer. Get President Trump on the campaign trail. And for Republicans, they really want to see that because the majority of the new voter turnout of the last decade of sort of the MAGA base, they're here for President Trump. They're not here for your average run-of-the-mill rank-and-file Republican. So those members really want President Trump to come to their district, come on the campaign trail. They would have liked to see him more in Tennessee, for example, a couple weeks ago, to boost the numbers because he is a turnout-generating machine. And there's a lot of anxiety on the Republican side about going into a midterm election cycle where the president himself, who is highly popular with the Republican base and MAGA voters, is not on the docket. Those voters tend to not show up in a midterm, which is why you saw such a shellacking for the Republican conference in 2018. They don't want to see a repeat of that, so they really want Trump to get on the campaign trail, come rally their voters, and get the turnout machine. Unfortunately, that's what Democrats also want, because they know that Republican voters that are supportive of President Trump are more likely to stay home. And the majority of Americans now have a negative view of the Republican Party's handling of the state of the economy, inflation, prices, housing, and healthcare. And those are the top 5 issues of voters going into the midterm cycle. So Democrats similarly want President Trump to be front and center. So it's really a tough row to hoe for the Republican conference and for President Trump in particular. He's got to get out there. He's got to talk about affordability, but the more he talks about it, the more it helps Democrats. So it's sort of a catch-22.
Good morning, Henrietta. So what of all those things that you mentioned, it seems to me that one of the most important things to try to nail down right now is healthcare, because you can't really change a rise in price levels. Whenever you do about further height doesn't matter as much as changing what's going to happen now with those subsidies. And this is a train wreck that's been coming and pushed off and pushed off and pushed off. Do you think that they can get something done in a time frame that's going to be meaningful? And do you think that there's enough bipartisan anything, because everybody is going to be affected by this? How does that look in your opinion?
Yeah, I'm not shy about making projections. There's no chance that they fix Obamacare before the end of the year. So we're going off the cliff. To put it into perspective, that's 22 million people that are going to be hit. 4 million people will lose their insurance. If you're 60 years and older, your premiums are going up by almost $1,000 in the new year. That's going to happen. There is this period of time between January 5th and January 30th, where they could find a solution. Our odds are pretty slim. My colleague Spencer Perlman is our healthcare expert, and he's now down to 25% that we get any 2-year, 1-year extension of the ACA subsidies. And you can hear it from Republicans in the United States Senate who saw this train wreck coming, as you rightly point out, and consider this, a subsidy that needs to expire. We have a $38 trillion debt load in the United States. Let's cut this and make sure that it is not extended. Unfortunately, when American consumers look at Republicans speak to the healthcare issue, we're now on year 16 of not having an alternative to Obamacare. So that leads to an erosion of trust within voters of Democrats and Republicans alike around the entire concept of healthcare for the Republican conference. Former Speaker Boehner had the best quote the other day, where he basically said, I've been in all these meetings with Republicans for a decade now, and we've never all been on the same page. And so as long as that's the case, you're not going to see a fix, and we'll go into the new year without one.
Henrietta Treyz of Veda Partners, wonderful to hear from you, as always. Thank you so much. And Sarah, this raises a question about how much stimulus some of the tax cuts will actually be if they're offset by increases in healthcare premiums.
It is one of the biggest issues, I think, that we face as a country, is the fact that you have this very opaque healthcare system. It's very difficult to understand how everything is priced, how everything gets paid for. And I think that, to Henrietta's point, the trust is gone in people getting it fixed by the government. And the problems that we have only gotten worse. They have not gotten any better. And I think the assumptions behind Obamacare did not work out. And instead of coping with that as they happened, they've just been pushed and pushed and pushed.
And it's going to lead to potentially another January fight that could end up with a January shutdown. Coming up, we're going to be speaking with Jayati Bharadwaj of TD Securities as we await 3 big central bank decisions this week. Plus, Yahira Anand with your Morning Movers. This is Bloomberg Surveillance. Good morning. A massive week to end 2025, the full trading week of this year. Really, it's the last one. And we get, of course, non-farm payrolls. We get CPI. We get some earnings. We get some rate decisions. Right now, people taking it all in stride, although reducing some of the enthusiasm from earlier in the session. S&P futures up 0.4%. You are seeing that dollar weakness continue to pervade the FX cross. Euro dollar at 117.54. And that bid into bonds does continue. 10-year yields down by almost 3 basis points. 4.1587 rounded to the fourth decimal point. Take a look at gold, rising back to all-time highs, 1.1% gain right now, climbing there after more than a 65% rally so far this year. 2 hours away from the cash open, here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We are seeing Micron shares rising nearly 2% in the pre-market on some sell-side action ahead of earnings this Wednesday. Wedbush raising their price target from $220 to $300, maintaining their outperform rating. And what they're saying is that stronger memory market conditions have set up Micron to benefit from higher average selling prices than anticipated. I will also note Micron shares are up some 180% year to date, so quite the run there. Meanwhile, ServiceNow not having the same luck. Shares are falling 4.4%. Honor reporting that it is in talks to buy the cybersecurity startup Armis in a deal that could be valued at as much as $7 billion, a price tag that Bloomberg Intelligence says seems expensive. It is also seeing some pressure due to some sell-side action, with KeyBank cutting its rating on ServiceNow to underweight. And we end on the Roomba maker. It has gone bankrupt, so shares are plummeting, down more than 70% in the pre-market. It plans to go private after handing over the reins to its main Chinese supplier. Its vacuum cleaners, autonomous vacuum cleaners, were all the rage at one point, but it has struggled to keep up amid heightened competition due to cheaper alternatives hitting the market. Lisa?
Thank you so much, Yahira. David, didn't Roomba used to do all the airports? Wasn't that what happened?
I've seen that before.
Yeah, they would like go around. What happened to that?
The novelties, maybe people stepping on them.
I bet the kids.
Crushing them, yes. Mine would have been all over them.
I mean, come on, chase them, the dogs and the kids. Meanwhile, on our radar this morning, President Trump saying he should be able to make recommendations on the Fed's interest rate decisions.
In the old days, it used to happen. Nowadays, it's sort of, they think it shouldn't happen. But I've done great. I've made a lot of money. I've been very successful. I think my voice should be heard.
The president is set to announce his nominee for Fed chair in the coming weeks. In an interview with the Wall Street Journal, President Trump saying Kevin Hassett and Kevin Warsh are his top choices. Meanwhile, Alphabet is set to book another sizable paper gain after SpaceX completes a tender offer that effectively values the company at $800 billion. SpaceX's insider share sale sitting at $421 a share, marking a sharp jump in valuation. David, the numbers get bigger and bigger. This, to me, just highlights how much fervor there is in the private markets and how big some of these companies are getting before they have an initial public offering.
Completely agree. Here as we look ahead to 2026, since I read our colleague Ed Ludlow's piece about this over the course of the weekend, struck by this line that the IPO would be for funding an insane flight rate, that's a quote, for its developmental Starship rocket, artificial intelligence data centers in space, and a base on the moon. So I think it's emblematic also of the gamble or bet one is making on Elon Musk's vision and ideas.
Yeah, and the idea that we're all going to go to Mars and potentially find our new
surveillance on Mars.
I think that, let me tell you, it will be hot on many levels. I wonder, Sarah, from your perspective, what this means about private markets and just how much froth has been building in the private space and not necessarily the public one, given the fact that there are huge companies that would be some of the biggest companies in the S&P 500 that are private, that are yet to actually come to the market and are less transparent.
Well, I think that you've had such a window of the ability of those private markets to raise money. I mean, it used to be that the IPO was the cash out. And now it's almost, I wonder if part of the reason the IPO market is so stuck is because the public market isn't willing to accept some of the valuations that are happening in the private market, right? So I think that there is a tension there. And it will be interesting to see how the SpaceX progresses. That is one of those companies like you're talking about that's had this huge growth and these huge valuations, and yet there's no sort of mark to market on the public side. I think that there is a lot of money that's been chasing both private credit and private equity. And there is a mismatch in some cases, I think, between the valuations.
And this is something that has been the reason behind some of the private equity firms and the lack of some of the exits that we've seen because of this mismatch in valuations. Meanwhile, the Wall Street Journal reporting 68% of CEOs plan to spend even more on artificial intelligence in 2026, despite no meaningful investment returns. An annual survey of more than 350 public company CEOs finds a majority believe AI will increase their entry level and senior leadership headcounts. The survey also highlighted, and Sarah, I'd love your thoughts on this, the fact that investors expect it to take less than 6 months for you to really start seeing much more profitability from the AI investments. CEOs saying it will take much longer than 6 months to see profitability from some of these investments. So how do we understand that?
So on the CEO side, you can certainly say maybe that's part of the under-promise and over-deliver. On the other hand, you can also say that investors are always expecting things to happen much faster than they actually have. And I think that that's part of the problem with some of the valuations is that they run up so fast. And if you don't start to see something, then you get that pullback and that narrative shift. And I think that that's one of those big tensions around AI that we're all waiting for. But even small incremental positive coming out of industry that says, yes, this is working, I think people will just extrapolate and they won't worry about the timing. But you need to see some of that happen, because if there's nothing to extrapolate from, then I think you have a problem.
It has to be more than
I keep going back to like the plasticity of the promise of AI, that companies say something's going to change or happen, but we don't know what that is in tangible terms. And we had some fun last week with this Disney announcement and the fact that maybe the great promise here is that we get a 15-second video with Mickey Mouse. I don't know if that's going to hold water going forward. So I think that's what it's going to take now, is sort of a broader rethinking of what exactly the promise is going to be here.
Yeah, an entire energy plant devoted to making Mickey Mouse.
This is what we've worked so hard for.
Speak your name in a 15-second sound bites. Turning to currencies, the dollar facing 4 straight weeks of losses ahead of a busy slate of data and 3 central bank decisions. Jayati Bharadwaj of TD Securities writing, we expect euro-dollar to head toward 118 by the end of the year on a turn in dollar sentiment and weak payrolls reports. We're almost there now. Jayati joins us now for more. Jayati, thank you so much for being with us. This is sort of the big question heading into the first 3 months of next year. Do we see the same kind of dollar weakening that we saw to start 2025 on the heels of a kind of similar dynamic?
Thank you so much for having me. I think that's a very important question. In fact, we are off consensus in calling another 5 to 6% weaker move in the dollar by middle of next year. And I think that also hinges on the fact that, there's been a lot of talk of AI capex. We were just on that, conversation a second ago, but there have been no tangible results, like you said. What that means is that the Fed's mandate is not what headline GDP is doing because of all of the capex investment we're seeing. The Fed's mandate is the labor market, which is not being propelled up. The majority of the sectors outside of tech are not seeing any gains, any tangible gains yet from all of this. The Fed's mandate at the end of the day is labor market. They will have to keep cutting interest rates if we don't see any strength. We have payrolls tomorrow, which is going to be a very important release. In fact, we expect the October payroll to show a contraction of 60K, which then rebounds into November, but that does not paint a very good picture of the labor market.
So this is the difficulty right now for me to understand the FX market, which has been highly confusing and basically stagnant for a while because everybody's equally confused.
Is it ever not? I don't know.
I mean, honestly, the yen is fascinating. There has been some really interesting interest rate-driven differentials, but there is this issue now. Are we talking about growth differentials? Are we talking about interest rate differentials? Are we talking about a Fed that's cutting rates? Or are we talking about a U.S. economy that still is growing faster than in Europe or in elsewhere? So how much does the growth rate supersede the interest rate cycle?
You're absolutely right. Currencies are fascinating. They're the most macro asset class there. They move on any and everything on any single day. It's both frustrating, but also exciting at the same time. I think it's about both. But it's all about relative to what our market expectations. The US, in terms of nominal GDP, will still be stronger than the rest of the world. But in the first half of next year, we still have the US growing below potential. So obviously, in terms of nominal GDP, the US is the largest economy in the world. There's no good alternative to US stocks. But it's all about relative to expectations. Is the US growing at the pace it was in the last 3 years when we had this US exceptionalism trade and narrative? Definitely not. And on the interest rate channel, which is becoming increasingly more important, the Fed is the only central bank out there where risks are more to cuts on the downside, whereas we're now talking about hikes at other places. That is also going to keep that downward pressure on the dollar in at least the next 6 months to come.
Lisa's pointed this out already, but I'll ask you just, this is not a quiet week There's so much central bank news this week, and I saw Goldman Sachs noting central banks in the Euro area, the UK, Norway, Sweden, Japan, Mexico, Indonesia, Hungary, and Czech Republic, Russia, Taiwan, Thailand, Colombia, and Chile, all scheduled to meet this week.
Yeah.
How do you look at them holistically, and what's the lesson we can take away from the decisions that are going to be made this week?
I think definitely very exciting. I think the two big focus points, which could be market moving in our purview, are the BOJ and the Bank of England, both in opposite directions, actually. We expect the Bank of Japan to hike after a very long time, which should provide some relief to the Japanese yen. We've all been waiting for that. It's been stuck in very weak ranges ever since the political turmoil started. But at least if the payroll, let's say the payroll reports tomorrow come on the weaker side, which leads markets to price in more Fed cuts, paired with the BOJ hiking, I think interest rate differentials can really push dollar yen back towards 150, provided some reprieve. And the other interesting one is the BOE, because they are still on the cutting path. In line with the Fed, definitely not as aggressively as the Fed. In fact, I think they will try to signal a very hawkish signaling because they're not ready to cut at consecutive meetings. In fact, I think they will signal that we're done, but don't expect us to keep cutting from here onward. So those are the two ones which we have our eyes on.
You didn't mention the ECB. It's proudly uninteresting. So they've just done a great job of telegraphing sort of what they're doing.
They're done. I think for the euro, what matters is if they can get the peace deal. And I think that's the main focus point. ECB is done. They're not going to talk about either cutting or hiking. The next move by them is more likely than not going to be a hike, which we think is definitely more a second half of the next year story. But they're very comfortable for now. I think the main point is what happens with the Russia-Ukraine peace deal. I think that's going to be very important for the euro.
So you mentioned the yen, and this is one of those currencies that's been used in a lot of ways that weren't just about the Japanese currency. What happens? Are they going to have to hike because rates are going up anyway? I mean, what do you see going on there, and how do you see that playing out over the next 12 months?
I think the hikes have become inevitable for them at this point. There's a lot of domestic macro momentum on the growth, inflation, and the wages side, which we saw overnight. And also now, we've had a new politician in power who is going to be fiscally expansive, which is not something that the currency or the bond market is liking. So in order to stem currency weakness, and outside of the MOF intervention, I think the only best chance for you is to show credible policy action through a rate hike. Imagine if the MOF starts intervening massively here. That's not going to send a good signal, even to the US, who have become very watchful of Japan's activities. And we know Besant has been commenting on BOJ and MOF's decisions a lot recently. So it doesn't look well for them. I think the only best chance they have is to hike interest rates.
Well, all currencies seem to have lost value versus the precious metal of gold so far this year. And I want to finish there, especially with gold prices surging back to all-time highs. Does this raise more concerns for the currency space, that there is this sort of broader devaluation of fiat currency that's happening at a time when, we're talking about relative values, but there is this bigger shift that could be durable?
I think we've spoken about the de-dollarization narrative for the last decade, but the only thing is it's happened at a glacial pace. What changed this year was the perception of the US dollar as a safe haven, which is what also has led to this bid in gold as the alternate safe haven, let's say, which can also shield you from a lot of the exogenous shocks we are dealing with right now. Obviously, the longer this extends, the uncertainty of policy in the US with Trump in power, with so many risk events, Supreme Court decisions still pending, I think that will likely keep a bid on gold and also a downward pressure on the dollar. There is definitely that de-dollarization or hedge dollar trade, which we're seeing play out.
Jayati, wonderful to have you here. Let's do it again sometime. Great to have you. Jayati Bharadwaj of TD Securities here in New York. Meanwhile, a tough weekend that's left us all reeling. We're talking a lot about markets and the economy because that's what we do. But our thoughts are squarely with the Jewish community in Australia and the student community at Brown University. These shootings shake all of us around the world. So we do want to get you an update on stories elsewhere. Here is your Bloomberg brief. Australia's government says it will consider toughening gun laws after a father and son killed 15 people in the deadliest terror attack in the country's history. The mass shooting at a Jewish community celebration of Hanukkah on Sydney's Bondi Beach also left dozens injured. Australian Prime Minister Anthony Albanese described the attack as an act of evil anti-Semitism. Brown University sent students home and called off final exams for the fall semester after a shooting killed 2 students and injured 9. The shooting occurred on Saturday in an engineering building, prompting a shelter-in-place order that was later lifted a day later. A person of interest was detained yesterday, but he was later released. Meanwhile, Volkswagen gearing up for its first production closure in Germany. In its 88-year history, the closure comes as Europe's largest auto manufacturer is under pressure due to weak China sales and demand in Europe, as well as U.S. tariffs weighing on sales in America. And that is your Bloomberg Brief. Up next, balancing the Fed's dual mandate.
To me, right now, we've got policy that's right around neutral. It's in that range of neutral. And when we've got challenges on both sides of our mandate, being close to neutral is probably the right place to be.
Russ Koesterich of Blackrock joins us next. From New York, this is Bloomberg Surveillance. Seeing a lift to markets as we kick off the last full trading week of 2025. We are seeing that lift to futures as people look back to last week and say, let's try to shake off some of those AI concerns. 0.5% gain on the S&P. Dollar weakening, taking hold. 117.55 on the euro-dollar cross. 10-year yields lower by about 2 basis points to 4.16, and gold surging back toward all-time highs, up about 1%. Under surveillance this morning, balancing the Fed's dual mandate.
To me, right now, we've got policy that's right around neutral. It's in that range of neutral. And when we've got challenges on both sides of our mandate, being close to neutral is probably the right place to be. I would prefer to be on a slightly more restrictive stance to help continue to put pressure on that inflation side of our mandate.
Here's the latest. U.S. Treasury yields inching lower as traders await key data for guidance on the state of the economy. Russ Koesterich of Blackrock writing, while the Fed is likely to temporarily pause in its cutting cycle, financial conditions remain supportive for risky assets. Russ joins us now for more. Russ, great to have you. Thank you so much for being with us. So let's just start there. This idea that does it matter if the Fed cuts rates? Are people putting too much emphasis on this idea of the Fed needing to ease policy and need to focus a little bit more on the actual economic backdrop?
Good morning, Lisa. I think that's correct. We have an environment where whether the Fed cuts once or twice next year, we can debate that. We have a very accommodative environment when it comes to financial conditions. You have an economy that's likely to accelerate in the first half of the year based on tax refunds, capital spending. You have an economy that appears to be benefiting from a productivity standpoint from AI. You've got a corporate sector that continues to produce incredibly strong earnings and cash flow. So to have everything hinge on whether the Fed's going to cut 1 or 2 times next year, I think that sort of misses the point.
Russ, I want to ask you about the place of bonds in portfolios today, sort of how you think about that. And I saw a piece in The Economist a few days ago indicating the bond market is quiet, perhaps too quiet. We haven't seen a lot of volatility therein. Yep. What's the role as you see it here as we round the corner into 2026?
See, this is a really interesting question for a couple of reasons. First of all, we're still in an environment where really for the first time since the late 2000s, you can build a high quality bond portfolio, lean into credit and spread, and get a 6.5% yield, something you were not able to do for most of last decade. So as a source of income, as a source of carry, bonds make more sense. The other thing that's happening, which I think is a little bit of a departure from what we saw in 2022 and 23 and 24, is that you're beginning to see some indications that bonds are once again acting as a bit of a hedge. In other words, more of a likelihood of bonds going up when stocks are going down. I think the reason for that, or one of the reasons, is that while inflation is still somewhat above the Fed's target, we have seen is that it's become much less volatile than it was in 21 and 22 and 23. And that drop in the volatility of inflation, giving investors a bit more confidence. So you can start to have the conversation again about whether bonds are likely to act as somewhat of a hedge as we go into 2026.
Are clients eager, willing to have that conversation now? How has the kind of attitude toward fixed income changed here in recent months?
Well, it's interesting. Certainly a lot of people were hurt in 22, one of the worst years for the bond market in record. So there's still a little bit of reluctance. But I do think that the ability to generate yield in a portfolio, the fact that we're still looking at an economy that is strong and a recession is very unlikely, it argues for having that portion of your portfolio in bonds that can provide carry. And again, if it can also add a little bit of safety along with other asset classes such as gold, all in all, in our view, that leads to a more robust multi-asset portfolio.
When you have discussions with clients, do you often talk about the fact that they are going to want to hold those bonds until maturity and not watch the fluctuations on the pricing? Because that's one of the things that gets people more worried. But in the end, if you can get that yield, you just have to stick around and take that and not get too worried about the price fluctuations when you get those interest rate shifts.
I think that's exactly right. And, to be clear, we think have benefited a lot of our portfolios. Much of the fixed income exposure, particularly on the credit side, we're able to buy that several years ago when spreads were much wider. And really what we've been doing is we've been holding that credit, holding those bonds in the portfolio, getting that carry, getting that tailwind. Another point, again, we've had 3 phenomenal years for equity returns. We may not quite get to 20% on the S&P this year, but the reality is this has been the best 3-year stretch since the late 90s. We do think stocks are going to head higher next year. We think earnings are going to power that. It may not be another year of 20% gains. If you can get 6-7% in the bond portion of your portfolio and do that with a lot less volatility, we do think that's going to be attractive for clients.
Would you rather be exposed to the AI story through credit or through equities right now?
I think it's still an equity play. The reality is you think about where do you want the convexity in your portfolio? It's on the equity side. And we continue to see, even with some of the recent pullback in AI names, a phenomenal year for tech, phenomenal year for a lot of those themes. There's likely to be more volatility. I think 26 is going to be more of a year where you're going to have to really think about stock selection, the industries you're in, pay attention to valuation. But by and large, we continue to believe this is a multi-year, probably a multi-decade theme. Having that exposure in the equities in your portfolio, it gives you that long-term convexity, gives you that long-term growth.
At this point, are you seeing concern build in credit space, in credit markets about some of the exposure to artificial intelligence, given some of the circular financing, given some of the higher degrees of leverage in the likes of OpenAI and related to Oracle?
I think there's definitely concern in general. Obviously, what we've seen this year is a continued growth in the capital spending. When you started the year, I think the expectation for the 4 hyperscalers was they were going to spend around $350 billion in CapEx. That number's only gone up for the year. It goes up further for 2026. So both on the credit side, but also on the equity side, you're getting this reasonable concern. If these companies are going to spend what could easily be $500 billion on capital spending, what does the return look like? What does the timing of that return look like? So I do think that's a reasonable concern. We're not overly worried about credit markets. We think in general, these companies are producing very healthy amounts of cash flow. But I said a moment ago, 2026 is likely to look different, both in credit and equities, that it's going to be more of a year of differentiation, not simply you buy AI and go to sleep, but more really thinking about what parts of that space, what names you want that exposure to.
Russ Koesterich of Blackrock, thank you so much for being with us. Sarah, has there ever been a time where you could buy something and go to sleep?
In retrospect.
Sure. Is there anything right now heading into next year?
It's very difficult. I mean, I just put out a piece on 2026 and looking forward. It was very difficult to write because it's very difficult right now to look at what's going on and say, I know what's going to happen in 2026. There are so many variables. There are so many things that people are excited about, but then pull back on. People are looking for, and then you think about how much dark fiber was laid, how long it took to absorb that. Are we overbuilding data centers? We don't know. Are we underbuilding them? We don't know. There are a lot of things that we don't know, and some of the, again, it's always in retrospect. You look back and you go, well, of course the AI spend was going to continue, so of course you needed to own all those names in big size. What's going to happen from here is a little bit trickier, and I think that all of us have to think about that for our clients and for ourselves and for the market itself. There is a lot of question. You've had a big change since 2008 in the financial crisis. And all of that is just different now than it was before.
Sarah Hunt, wonderful to have you here as always. Sarah Hunt, Chief Market Strategist at Alpine Saxon Woods. Coming up in the next hour, Keith Lerner of Truist, Sucharita Kodali of Forrester, Pooja Sriram of Barclays, and Alessio de Longis of Invesco as we head toward a really busy last full trading week of 2025. This is Bloomberg Surveillance.
The market doesn't like uncertainty, it loves it.
The acronym of the year is AI.
I think the AI story is growing.
Next year, I think, is really going to be the year of the AI adopter.
There is a lot going on into next year. We're positive, but I think there may be some volatilities.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
morning. Welcome back to Bloomberg Surveillance, a busy end of the year with traders preparing for a stacked week of economic data and policy decisions. Markets searching for that holiday melt-up as investors shake off AI skepticism and growth fears. The focus now turning very much to delayed non-farm payrolls report out tomorrow. We get November CPI on Thursday, a slew of earnings, Nike as FedEx, and of course we get University of Michigan sentiment survey on Friday. David Gura, honestly, in this third hour of surveillance, it seems like people really gearing up to try to understand the Fed and the Fed versus AI.
Yeah, we get the opportunity to hear from some Fed policymakers this week as well. Stephen Myron's going to be speaking here in New York. So again, kind of getting a fuller sense, a more holistic sense of what the Fed did last week, and people will carry that into the new year. I think this kind of conversation about AI continues as well.
Well, it's sort of this push-pull where you have the economy that hasn't been doing fantastically, but it's been supported by the AI narrative. And there's a feeling, at least in the first 2 hours, where people were saying you have to start to see the economy catch up on some level in order for the AI promises to really have come to fruition, just because how are you profitable in a society that doesn't have the money to pay for it?
Yeah, show me something. Show me what those promises are in actual effect. And then I think going back to what the Fed chair said last week, you detect an interest from policymakers here, I think, in kind of wrestling with what AI is going to actually mean for this economy going forward.
Yeah, and is it going to be the Oracle story or is it going to be the Google story? Two very different sides of possibly the same coin. Right now in markets, you do see a lift across the board throughout indexes, but you do see that broadening out that people have been hoping for to end the year. 0.8% gain on Russell futures. S&P futures up about 0.5%. Similar move on the NASDAQ. You do see a bid into bonds. This is going to be important, especially heading into a 20-year auction later this week. It is coming across the board, but in particular at the middle of the curve. The 10-year yield lower by almost 2 basis points at 4.16, although pulling back from some of the earlier lows. You are seeing this expectation of a Fed cutting rates. You did see that yield curve steepening. 30-year yields 4.83%, steepest yield curve going back to 2022. Coming up in this hour, we've got Keith Lerner of Truist, with stocks rising to start the last full trading week of 2025. Sucharita Kodali of Forrester looking ahead to fresh retail data this week. And Pooja Sriram of Barclays as investors await the November payrolls report. We begin this hour. Stocks are higher as Wall Street aims to bounce back from Friday's losses. Keith Lerner of Truist writing, we are still positive tech longer term, but in the near term, there is a lack of a catalyst for the sector, so investors will need to be patient. Investors known for their patience. Keith joins us now. Keith, thank you so much for being with us. I just want to start there. I mean, do you think that this sell-off that we've seen, or underperformance, I should say, probably putting it more fairly, in the tech sector is something that can persist for a longer period of time, or is it just sort of like an end-of-the-year melt-off, given how much it's been outperforming?
Yeah, well, first, great to be with you. I didn't realize it was actually the last full trading week of the year, so that's exciting in some ways. So to your point specifically, Lisa, listen, I still think tech is long-term leadership, but to your point, we went up off the lows about 70% versus 35% for the S&P 500, and now you're getting all these different questions as well. So I just think it's a point where, you know, that we have to kind of rebuild that wall of worry, which we're doing. But at the end of the day, the earnings momentum for the tech sector is still the strongest one out there. So I think in the near term, I think the challenge is, what is the catalyst to move this up? Because, you know, we just went through earnings season. People are focused on, obviously, Oracle. NVIDIA comes out with some news about some more chips selling to China. It's not moving it. So I think it's just maybe a digestion phase. And I think, you know, next year at some point, maybe that's 3 months or 6 months from now, we'll see money rotate back into it. And when we look historically at bull markets, maybe my final point here is, the leadership of a bull market tends to endure towards the end, notwithstanding periodic, pullbacks and rotations. We're seeing one of those rotations right now on this kind of broadening theme, and I think that broadening theme, at least near term, has a bit more to go.
You sound somewhat skeptical of it long term. Is that correct, Keith, that this broadening theme maybe is a short-term blip, but not necessarily a 2026 full-year trend?
No, I think, you know, at least if we were here a year ago, I think the theme was very similar about this broadening theme. It didn't work out. But no, I do think next year there's more of a reason that we could see more broadening. So I think a lot of times people think about it's tech or X. And in our view, it can be both, especially as we have these sharp rotations. But, you know, the good news, I think, as we think about the equal weight index, we came into this year around the 17 multiple. We're ending the year around the 17 multiple, and it's been mostly earnings growth. The key for next year is profit margin. And do we see the adoption and the profit margin start to expand for these 493? But I think, listen, in near term, we are seeing some positive action. We had industrials break out last week. The equal weight index just made a 52-week high. Here's an interesting stat, guys. the equal weight index is only up about 4% since the November peak right after the election. So almost more than a year, we're only up 4%. So no, I think it has further to go. I just think it's both, not either or.
There's a tendency to have this kind of monomaniacal focus on the big tech names, the Magnificent Seven and the like. Do you foresee, as you look into your crystal ball, more eagerness to look overseas in the year ahead? Of course, markets overseas have done extremely well this year in many cases. Are you looking more to Europe, for instance, in 2026?
I don't know that we're looking more, but it's kind of a similar story. When we look around the globe, I just checked this morning, 98% of the markets we track, more than 40 countries around the globe, they're in uptrends defined as above their 200-day moving averages. So it's kind of that similar story we just had. It's like either or, no, both. We still have a tilt toward the U.S. because that's where the innovation and earnings are there. And if we think about the last year, the U.S. underperformed, but that was after, in the prior year, the U.S. had outperformed by the most since the 90s in 2024. So we had a bit of mean reversion, and almost all the increase in international was PE valuation, not earnings, and the currency side. So I think as we move into next year, we had a bit of a revaluation. Currency has come down to the U.S. dollar. So I think both will do well. We're still tilting towards the U.S. on the margin.
We've been kind of threading this needle over the course of the 3 hours this morning. Mike Wilson's note. Mike Wilson and Morgan Stanley write about how we're now firmly back in a good is bad, bad is good regime. As you look ahead to this week and the data that we're going to get, how are you thinking? Are you in agreement with Mr. Wilson?
I think the market likes Goldilocks. I think we want an economy that is still, kind of chugging along. We expect a modest uptick into next year with inflation that doesn't get out of control, which we don't think it will, and interest rates that remain, kind of in this range that it's been overall. So I would say on the margin, solid news is good news. I don't think we want either extreme. If it's something that's really much stronger to the upside for the economy, that probably means rates go up and that will hit maybe valuations. If we see a real weakening in the labor market continues in this divergence between GDP data and labor market, I think that's problematic as well. So I think, we're using an analogy for our outlook, the seventh inning stretch. I think we want something kind of in the middle between those two extremes.
Do you think, Keith, that this market's fully wrapped its heads around the idea that we have seen the end of one of the biggest global easing cycles ever outside of some sort of recession?
It's an interesting question because it hasn't really come up a whole lot in conversations as I speak with investors. So I think that is, potentially a risk. And I think the other thing, all things come back, or all roads lead back to the 10-year Treasury. As we think about next year, we still are positive. We think the uptrend deserves the benefit of the doubt. But going to your point about central banks, I think the key tell for next year and the risk factor we'll be watching is the 10-year, which, again, seems relatively contained at this point. But that is a shift. And I think just like this past year, I think earnings will be the key. Again, we expect solid earnings, and we do expect those earnings to burn out as we move through 2026.
When you talk about earnings, this kind of leaves us in the same place of, yes, bonds may offer a hedge, but maybe you don't want that hedge in 2026. Maybe you want to be exposed to the equity space and then on the short end of the yield curve at a time of yield curve steepening. How do you look at that kind of interplay, given the fact that people are expecting enough growth, an accommodative Fed despite that ongoing growth, and this yield curve steepening that we have seen really start to reassert itself?
Yeah, so overall, heading into the year, we do have a modest tilt towards equity relative to fixed income and cash. We're still overweight gold as well, which we've been overweight all year long. And then on the fixed income side, again, going back to the analogy around baseball, we still look at fixed income as that consistent hitter, kind of collecting that coupon. All in all, over this last year, where the equity markets have done pretty well, we are having a solid year in fixed income with high quality returning 6-7%. And I think as we think about next year, we talked about there's a lot of cross currents. There's a midterm election year, and there's a scenario where the economy is stronger than expectations, or there's a scenario where the labor market weakens further. In the latter one, you would actually want bonds. So I think going back to diversification, the kind of the simple diversification aspect, you still want to have bonds. Are they at a modestly lower rate? Yes, but I still think it makes sense. But we are pairing that with some exposure to gold still into the new year.
Let's stick with diversification. So there's this market masonry building the wall of worry. As you look beyond tech, if you look beyond big tech, telecommunications as well, where do you see opportunities sector-wise here in the year ahead that might have been neglected in 2025?
Sure. So where we were overweight tech and communications for most of this past year, and we still are, again, we're still positive long term. What we've been doing is making incremental changes based on this broadening theme. So over the recent months, we added healthcare. Healthcare is a sector where just, a little bit of good news can go a long way. I know it's done better recently, but it's underperformed the S&P by over 50% over the last 3 years. And that's a historic extreme. So you just get a little good news that can go a long way. And we're seeing valuations attractive and some better fundamentals there as well. And then just last week, we upgraded industrials. Industrials was a hot sector early in the year. Since July, it kind of moved sideways, only up about 2%. It just broke to the upside of a five-month trading range. And as we think about this economic uptick that we envision and some of the benefits from the One Big Beautiful Bill, like accelerated depreciation, we think that's an area that should benefit as well. So again, tech communications now paired with healthcare and industrials, and something else we're looking closely at, not quite there to upgrade. Financials with that steeper curve that Lisa mentioned earlier are acting very well.
Keith Lerner of Truist, thank you so much for being with us. Have a wonderful holiday season. Right now, let's get you an update on stories elsewhere this morning. Here are your Bloomberg briefs. NVIDIA has told Chinese clients it's evaluating adding production capacity for its H200 chips after orders exceeded its current output level. This, according to Reuters. The move comes after President Trump announced the U.S. government would allow NVIDIA to export H200 processors, its second fastest AI chips, to China last week. Alphabet set to book another sizable paper gain after SpaceX completed a tender offer that effectively values the closely held company at about $800 billion. SpaceX's insider share sale was priced at $421 a share, which would mark a sharp jump in valuation from earlier secondary transactions. That is likely to lift the carrying value of Google's longstanding investment in Elon Musk's rocket and satellite company. Meanwhile, spare a thought for Roomba. Roomba maker iRobot is expected to go private after filing for bankruptcy. The company, founded by MIT engineers in 1990, is looking to hand over control to its main Chinese supplier. iRobot sold more than 40 million home devices, but saw a post-COVID decline due to supply chain issues and cheaper competition. Wasn't expecting to see lots of Roombas this morning. But over the weekend, that was very much front and focus. That is your Bloomberg Brief. Did you ever use Roombas?
Never had a Roomba, but I had friends who had them, and I was admiring of them, but I somehow knew, I didn't know that it would end this way.
Yeah.
Not to say it's ending, I should say, but no, I never went all in and got one.
I actually love the idea, but I never got one also. But I do think that it would be great, especially if you could do other things, like bring you things.
Yeah, like put the coffee on top of it
exactly.
and have it move around.
Have a little baby that's
maybe that's
like
the future. Maybe this Chinese company will
make it.
Take that. I don't know.
Up next, the morning calls, plus Sucharita Kodali of Forrester looking ahead to fresh retail data this week. That's coming up next from New York. This is Bloomberg Surveillance.
We are, on the optimistic side that growth will improve. We'll get more balanced growth next year. We're going to get quite a bit of stimulus starting in the first quarter. Tax refunds could be, $50 billion. I think those refund checks do help to boost consumer spending.
That was Kathy Bostjancic of Nationwide on what's ahead for the consumer as we get retail sales tomorrow alongside non-farm payrolls. And on Thursday, we get, of course, CPI from November, a check across the broad economy ahead of the January Fed meeting. Right now, the check on markets is broadly positive, up about 0.5% on the S&P. Dollar weakness, watch the space. The euro gaining about 0.1%, 117.55 on the euro-dollar cross. And yields lower, but not as much lower as they were earlier this morning. The bid driving 10-year yields down to 4.17% rounded up. Gold on a tear, pulling back a little bit, but still back toward those all-time highs. Time now for the morning calls. First up, Morgan Stanley upgrading Hershey to overweight from equal weight. The firm saying the stock offers rare visibility into significant earnings growth within staples. So shares up 1.5% in pre-market trading. Up next, JP Morgan upgrading Dollar General to overweight from neutral with a price target of $166. The firm seeing upside, saying Dollar General is back on offense. Those shares up 2.6% in pre-market trading. And finally, Roth Capital Partners downgrading Costco to sell from neutral, a rare sell rating from the sell side, citing concerning underlying metrics and intensifying competitions. Those shares lower by about 0.8%. Sticking with retail, October retail sales data set to provide another look at the state of the consumer tomorrow. Sucharita Kodali of Forrester writing, retail sales have been more positive than consumer sentiment suggests, but much of that may be biased by mass and essential merchants. Sucharita joins us now. Sucharita, that's a great way of framing it because we've been trying to understand the retail sales data that we have been getting, as well as the earnings. Is this inflation? Is this staples? Is this an issue of the higher income individuals padding out some of the totals? What's your first read on just how good retail sales have been?
Well, I think that the big story is really this K-shaped economy expression that we're hearing a lot of now. Ultimately, where we definitely see strength is certainly with the affluent consumers. And you see that reflected not only in the stock valuations, which, of course, are certainly padding the net wealths of a lot of consumers and empowering them to purchase everything from essential goods to certainly some of the more discretionary items as well, whether it's in sectors like automotive or home. But what we also are seeing is really, really low shopper sentiment as well, consumer sentiment. And that's largely dragged down by some of the lower income consumers, the demographics that are not in the top 10%.
That's right where I want to go. And I keep harping on this, but there's something really funny about that we've seen strong retail sales still yet. Maybe again, we'll see them tomorrow. But all the while, there is this negative sentiment. And I wonder if you look for like historical analogs, are there any that come to mind? Is this a kind of unique new phenomenon? And what does it tell you about maybe the prospects for consumer spending, retail spending going forward?
Well, this is unusual because typically consumer sentiment and overall spend are correlated. So every time we have seen recessions in the past, you typically will have negative consumer sentiment. But all of the indicators are that the economy right now is still doing relatively strongly. GDP has been positive. You have unemployment being relatively low, wages on average being relatively high. So all of those key macro indicators are very, very strong, but yet you have very, very low consumer sentiment. And there are some reasons that have been speculated about. It's everything from the advent of AI, leaving a lot of people uncertain about the future. You have other issues related to just even inflation and consumers feeling that they may not be getting as much value for their money. We certainly see this with a lot of consumer packaged goods and a lot of essential goods that consumers are purchasing, where not only are the unit prices going up, but the amount of value that the shopper is seeing in a number of those goods is actually going down. And that could be one of the reasons that we're also seeing that negative consumer sentiment in spite of wages being higher.
As I think about the K-shape here, and I wonder sort of what this part of the K can do. Can it pull up sentiment? Can it kind of give consumer spending, retail spending more broadly a lot of juice? Or do you need that like lower half of the K to be working as well?
Well, for the higher income consumers to pull everybody up, that is essentially the argument of trickle down economics, right? And unfortunately, that hasn't always proven to be the best economic approach. What we saw during the pandemic was when we gave enormous government stimulus to the broad economy, and it was a fantastic experiment in how being able to provide stimulus to the masses really supported economic growth, because we saw some of the fastest growth rates that we had seen in a long, long time. And what that ended up doing is it overheated the economy to the point that we saw the inflation numbers that we're now continuing to try to bring down. So I think that it is somewhat difficult to say that the top end of the consumer demographic is going to single-handedly pull up the rest of the economy. We definitely need more broad sentiments of of economic well-being in the economy, I think, in order to get those sentiment numbers up. But then there's also the other argument that maybe we shouldn't even be looking at consumer sentiment as a factor at all, because if it's not correlated to spend, we should be looking at other things like maybe housing starts or joblessness as better indicators.
Or maybe fiscal stimulus, which is what some people are expecting early next year. You were talking about some of the cash infusions under some of the post-COVID relief plans. Next year, a lot of people are saying that what you're going to get is a huge tax break and it's going to leave people with a lot of cash. How are retailers shaping up to take advantage of that? Clearly, they're paying attention and there must be some expectation.
Well, retailers try to take advantage of the cash refunds every year, so that's not necessarily a new strategy. The challenge is that Q1 tends to be a softer time in general for retailers. There are fewer sales. There are some exceptions in some seasonal categories, like maybe jewelry in February. But for the most part, Q1 isn't a terribly great time. You have a lot of returns that you're processing and a lot of just exchanges that retailers are seeing rather than the purchase of new goods. We really don't see much more of that higher year-over-year growth until later in the year.
Sucharita, Kodali of Forrester, thank you so much for being with us. We really appreciate it. Have a wonderful holiday season. Let's turn to the economy. We've got a key week of data on deck. Bloomberg's Michael McKee joins us now. Not just data, we also have a lot of Fed speak. A real focus, though, here, how much does some of the data matter other than non-farm payrolls, or really is it all about the unemployment rate?
Well, it's mostly all about the unemployment rate, but we aren't going to get one for October, so it makes it more difficult to interpret these numbers. We were just talking about it in the green room here. Exactly what is it going to mean? The one number we're going to get this week that will be easy to interpret, but probably the least meaningful, is going to be retail sales tomorrow, because retail sales, we got the September numbers, and these are the October numbers. So we'll actually have a month-to-month comparison, and in September, the numbers weren't pretty good, just 0.2% overall, and the control series was down 0.1%. Now, both of those are expected to rebound in October, but it's not going to tell us what happened in November and give us an idea of what was happening for the holiday season. So it's going to be the more complete number, but it's going to be one that it helps us a lot figure out where the economy is.
Mike, stay close. I know that you're going to be with us in just a few minutes, and we are going to be getting a little bit of data earlier this morning. We'd get Empire manufacturing data coming out in about 5 minutes' time. A real question here, David, as we look out about what to trust, given the fact that the numbers have been messy, they have been inconsistent, and we just heard this idea from Kodali talking about how maybe we should ignore sentiment data, given the fact that it hasn't been reliable.
And we don't have the continuity of the series as well, which is another facet to this too. No, I think it's a fascinating thing to bear watching. And again, we've kind of been through this period where there's been a lack of data, there's been delayed data. We're beginning to get something toward normalcy here, but we've seen the Fed proceed, soldier through all of this, wondering sort of how policymakers will proceed now. We've had this kind of coloring the decision that they made last week.
Well, if you're curious about what they think, we have a number of speakers on deck, including John Williams, of course, Chris Waller, we have Stephen Myron, we have Raphael Bostic, we have a host of other speakers who can give you a sense of just how they feel. Coming up, Pooja Sriram of Barclays will be joining us as investors await the November payrolls, plus Yahira Anand with your morning movers. Shares of ServiceNow falling as they're nearing a $7 billion deal to acquire Armis. Those shares lower by about 5.4%. You're watching Bloomberg Surveillance. Good morning. A lift the last final trading week of 2025. We are seeing stocks broadly higher, led by the small caps, up now about 0.8% on Russell 2000 futures. S&P futures up by 0.5%. Similar on the NASDAQ, a bit into bonds pretty much across the board, although it's fading as the session grows older. An eye towards some of the economic data we get throughout the week. At the long end, it's almost completely flat at this point. So really a question about that yield curve steepening continues with that 30-year yield at 4.84% when you round it up, and you've got a similar kind of move. 10-year yield almost back at 4.17. 2-year yield just pinned there at 3.50. 1 hour away from the cash open. Here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We start with Intel. Shares are rising 1.3% on some M&A's chatter. We are reporting that Intel is in advanced talks to buy AI chip startup Samba Nova in a deal that could be valued at $1.6 billion, well below its valuation back in 2021 of $5 billion. So investors are reacting positively, not just because it would be a bargain, but also because it gives Intel a platform to compete with NVIDIA's AI chips. Meanwhile, also moving on some potential M&A action is ServiceNow. Shares are moving in the opposite direction, down 5.25% on a reporting that it is in advanced talks to buy cybersecurity firm Armis in a deal that could be worth up to $7 billion, a price tag that Bloomberg Intelligence says seems expensive. We are also seeing some weakness due to some sell-side action with KeyBank cutting its rating to underweight of ServiceNow. And we end on IMAX, also some sell-side action there. Shares are rising 3.5% after JP Morgan upgraded the stock to overweight. The analyst has had a change of heart and now sees IMAX as more than just a theater chain. Rather, he says it's a premium live experience brand benefiting from a strong slate of upcoming films. So he is raising his price target to $47, which is about 20% upside from here. Lisa.
Thank you so much, Yahira. I love that. We're not a movie business. We are an experience business, which is very much, I think, what everyone is trying to be. Turning to the economy ahead of tomorrow's payroll data, Bloomberg's Michael McKee back with us. And Mike, I know you're going to look ahead to everything that we're going to get this week. I would love your thoughts, though, on Empire Manufacturing from New York, given that it really was quite negative.
Yeah, negative 3.9, down from 18.7, and pretty much all of the underlying aspects, shipments, production, and orders are down significantly. The only things up a little bit were employment and a bit of a decline in the prices paid and prices received indexes. But this is contemporaneous data. This is December, some of the newest stuff we've got, so it does matter a little bit. Now, tomorrow, jobs. In our last episode, I feel like one of those shows that has to catch you up on what happened the last time in case you missed it.
Preview.
September payrolls, we got that in November, 119,000, and unemployment was 4.4%. The forecast for October, we don't have one because there's no October data that we can build on there. But for November, the forecast for jobs is 50,000, which would continue a trend of very, very slow job growth. The big unknown in this is how many federal workers were furloughed and not counted, and how many were doged when you were laid off. Your payments ended at the end of September, so that could be a big drag on October. We do expect the healthcare segment to keep hiring. The one number to rule them all, of course, is going to be unemployment. It is forecast to tick up to 4.5% in November, but we won't really have a comparison because there's no October household survey, so no October unemployment rate. We will be watching labor force growth. There's a big question about what's happening, of course, with the deportations. And then don't touch that dial because tomorrow, of course, we also get the retail sales numbers we just talked about. And Wednesday, we'll have Waller, Williams, and Bostic, and they can comment on all those things. We have Waller today along with Myron, but the data aren't really there for them to talk about yet. Thursday, CPI, that'll be big. The forecast that we have now is for 3.1%. We only get year over year. There's not going to be a month over month because there's no October CPI. Jobless claims and Friday, existing home sales. Everybody's watching those to see if mortgages are going to make a difference. So far, they haven't. So this is perhaps the biggest week we've had for the economy in months, and I'm just trying to remember how to do it all.
Michael McKee, you're doing a great job. Stay tuned as Michael McKee unravels who stole the knife. Thank you so much, Michael McKee. Pooja Sriram of Barclays writing, we expect non-farm payroll and employment flat in October and up 50K in November, providing further evidence that the labor market is slowing but not breaking. Pooja Sriram of Barclays joining us now. Pooja, great to see you. Thank you so much for being with us.
Thanks.
So just looking at slowing but not breaking, what's the difference between the two? How narrow is the gap between slow and between broken?
Yeah, I think that's a great question. I think we're getting close to the point where people, ourselves included, are seeing risks clearly to the downside. But in terms of breaking, that is a world where you expect labor market slack to shoot up.
pick up very rapidly, and that's not something we're seeing either in the official data or in some of the other statistics, like, think about job openings and the separations rate there, or jobless claims data. So it is a labor market which for a while now has been stuck. We're not hiring, but we're not firing as much. So there's very little dynamism. Risks are to the downside, but we still think we're not at that point where we're ready to fall off the cliff.
Well, I guess I'm wondering if we're at an inflection point of sorts, or maybe we've been grinding along, we could be heading toward an inflection point. Why wouldn't it be to the upside? Because we have seen smaller businesses really pull back in hiring. The hiring has been concentrated in the larger companies. If they get some stimulus, if there is these rate cuts that kind of start percolating through the economy, why wouldn't we see a pickup in hiring rather than sort of the other way around?
That's a great question. And I think that's a very feasible scenario to keep in mind, just given we are quite constructive about growth into 2026. We're seeing a lot of positive impulses that could keep the economy highly supported. And in that world, yes, you could have a labor market that actually stabilizes. In fact, our own forecast, official forecast, has the labor market looking quite resilient in 2026. And we have the unemployment rate coming down. So I think we really subscribe to that view that there is a world where the labor market stabilizes and eventually starts to look better. But given where we are now, I think it's reasonable to also see that risks could very well be to the downside. It would take very little to push the labor market in the opposite direction.
I'm curious how you think about the legacy of what we have been through here with this government shutdown, the delay of data that we hadn't seen before, and all the while there was this conversation about what might be a decent substitute for the data that we weren't getting from the Labor Department. How could we get as good a sense as we could about the state of the labor market in light of not having that data? Now that we're beyond it, I'm curious sort of what we've learned about how good a sense we have of the jobs market in this country. We heard from the Fed chair suggesting perhaps there are more fundamental problems with the way that these job numbers are collected and counted. How are you thinking about what we've been through?
Absolutely. So I would say this, that the government shutdown basically brought to the forefront the fact that we are highly, highly reliant on official statistics. And there's a good reason why. We have very talented statisticians who've been doing it the right way for a very long time. But at the same time, I think it also exposed the vulnerabilities of suddenly not having these data, or now we're in a scenario where the data could be clouded in some sense, right? To answer your question, we have looked at a dashboard of indicators which are quite useful and are reasonable alternatives to get a gauge of where the economy is headed. And these come in different shapes and forms. You've got job openings data, you've got job postings, some of them about hiring. So it gives you a decent picture of where things are, but we still don't think those are enough to substitute the official statistics.
I suspect Lisa's going to ask about inflation in a moment. Before we get there, let me just ask you about the Fed speak that
Mike was,
I'm sorry. that Mike was mentioning, all that we're going to hear from. And I'm curious, what are you listening for in specific? We've talked a lot about the silent dissents, the quiet dissents that happened at that meeting. What are we likely to learn from the kind of panoply of speakers who are going to be giving remarks and interviews over the course of the week?
Yeah, I think the one thing that stood out in the December FOMC meeting is just how divergent views are within the committee. I mean, if you just look at even the dot plot, for example, in 2026, 7 participants felt that it's appropriate to hold rates steady where they are now. So I think going into this week and also just, beyond this week, we want to get a sense of who's thinking how. For example, we did hear from Goolsbee that his dissent was to some part tied to the fact that he didn't have enough data to go by, right? And so that gives you some insight into, I guess, what he's looking for. And, we're likely to get similar insights from others. And I'm sure, like a lot of other Fed watchers, we're trying to place them on the Dove Hawk lineup to see exactly where their minds are at. And to give us a sense, really, of what the reaction function is for each of these participants.
Over the weekend, San Francisco Fed President Mary Daly put out a blog post, and she was talking about why she supported cutting rates the last meeting. And she talked about how, yes, it was a very difficult decision because there is this dual mandate that's very much in conflict. She was talking about inflation. Yes, I was going to talk about it. And how it has been really punitive for these families. But she said, how you get down to 2% matters, because if you get there too quickly, you break the labor market, and then you've got families families grappling with both above average inflation and potential job losses. Do you think that there is this theory right now presiding over the Fed to run the economy a bit hot, especially at a time of technological transition, with artificial intelligence posing some existential questions around the labor market, in order to avoid some sort of labor market scarring at the expense of inflation not getting down to 2% anytime in the near future?
Well, this is what I think stood out to me in the December presser. There seems to be this view in the Fed that inflation is really not a problem right now. In fact, Chair Powell's own comments on inflation is he's quite sanguine about it. I think in some part of the presser, he did think that inflation, you strip it out of all the tariff effects, is somewhere in the low 2s. Then he mentioned something about productivity also likely to support the economy. So if you sort of put all those views together, I think there is this view out there in among the Fed participants that inflation is perhaps not a problem to be concerned about, and what they need to be concerned about right now is the labor market. That's perhaps what Mary Daly is also subscribing to in some sense. My own take is I think it's a little too premature to think that inflation is going to take care of itself. We at Barclays have been saying for a while that we are yet to see the full effects of tariffs on the inflation data. And sure, while it may be a one-time price shock, I think it's a little too early to declare victory on inflation yet.
Pooja, Sriram, thank you so much for being with us. Really wonderful to get your thoughts, and have a wonderful holiday. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Briefs. Ukrainian President Volodymyr Zelensky has signaled Kyiv could accept security guarantees from the United States and Europe in place of its long-term goal of joining NATO. Zelensky met with a U.S. delegation in Berlin on Sunday. Ukraine has sought NATO membership for years, but has altered its rhetoric as Washington presses for the war to end. A JetBlue flight halted its climb to avoid colliding with a U.S. Air Force tanker on Friday. According to air traffic control recordings, the pilot flying from Curacao to New York's JFK blamed the military craft for crossing its flight path. The incident comes alongside increased military presence near Venezuela. The Air Force did not immediately respond for comment. And in sports, the LA Rams clinching a playoff spot with a win over the Detroit Lions. Michael Barr will be very happy. Meanwhile, the Bills came back to beat the Patriots, and the Ravens shut out the Bengals. However, the biggest news from the NFL Sunday, Chiefs quarterback Patrick Mahomes and Packers defender Micah Parsons both suffering season-ending knee injuries. That is your Bloomberg Brief. Up next, setting you up for the day ahead, plus Alessio de Longis of Invesco as he was remaining overweight equities heading into the new year. From New York, you're watching Bloomberg Surveillance. Good morning.
I think non-farm payrolls is far more important for the Fed because they have told us that they will look through any kind of stickiness within CPI on the good side of things because of tariffs being considered not transitory, but a one-time impact. I think the important thing on inflation is that if we look at those big components, as Kathy was mentioning, you're still seeing wages look like they're pointing lower.
That was Cameron Dawson of NewEdge Wealth earlier this morning, ahead of what is going to be one of the busiest economic data weeks of the year. Right now, markets really increasing, gaining steam throughout the morning, up 0.5% on S&P futures. Seeing that dollar weakness, 117.57 on the euro-dollar cross, and yields down on the 10-year, almost 3 basis points now to 415.87. Sticking with central banks, Treasury yields edging up ahead of this week's data releases after the Fed outlined plans for a new round of bond purchases that Ira Jersey and the rates team at Bloomberg Intelligence is called quantitative easing light. Ira joins us now for more on what this means. Ira, don't call it quantitative easing. This was sort of the announcement that tried to sound like paint drying. It did not work that way in markets. How is this like quantitative easing, even if not quite?
Yeah, so if the Federal Reserve was just doing $5 to $10 billion a month in these reserve management purchases, I could make the argument that it's not quantitative easing. But the fact that the Fed has decided that it's going to be doing $40 billion a month for at least a few months and up until tax day, you have to. There's going to be a similar reaction in risk asset markets in particular to quantitative easing. Now, it's not going to be sustained, and I think that that's an important aspect of this, is that you are talking about a 3 or 4 month purchase program of around $40 billion. It's also not designed to get long-term yields lower, because they're only going to be buying T-bills and very short-term coupon debt, so things like 1 year to maturity debt. So that's not going to have the effect of like getting mortgage rates down very, very much at all. So it does have a much different both effect but also purpose than quantitative easing did back in 2020 or in 2008 to 2014 as well.
So, Ira, is it fair to say this will support risk assets in a broader sense, with the signal that the Fed is going to backstop and expand its balance sheet to manage liquidity at a time where liquidity has changed based on how big the deficit is in the United States?
Well, it's not only the deficit. You know, the big change here is like, look, I know that there's some people who are saying, well, look, before 2007, we didn't have any excess reserves and we had very small balance sheet. But the fact is that one of the reasons why you have this bump in liquidity here, or need a bump in liquidity here, is because reserve balances are now used for a lot of the Basel regulations by the large banks. And so the thing is, you need these reserves in the system in order just to keep the plumbing working. So the Fed went too far. This is an acknowledgement by the Fed that it went too far in shrinking its balance sheet, and now it has to, make up for that little bit, because, this idea that Jay Powell has said, like, look, we want an ample reserve regime. Reserves are either ample or they're not. So you really need to have a buffer above this tipping point of reserves, which, we've now proven is somewhere around $2.9 trillion in reserve balances at the moment. And then naturally, those are going to have to grow as the economy grows, because that's just the way it works. And keep in mind, and this is something that I think a lot of people who have only been in the markets for the last 15 or 20 years forget. Prior to 2007, the Fed expanded its balance sheet almost every single month from 1973 until 2008. And so this would not be that unusual. Again, if they were doing small amounts, $5, $10 billion, $40 billion has to be called QE light in my book.
Ira Jersey of Bloomberg Intelligence, thank you so much for that. Turning back to markets, more broadly, futures getting ahead of the year's last full trading week. Alessio de Longis of Invesco eyeing broader opportunities in 2026, writing, a recent shift towards value and small and mid caps and broad diversification between U.S. and non-U.S. equities should provide better downside protection. Alessio joins us now. Alessio, thank you so much for being here. It's great to see you. So how has the concept of diversification changed over the past couple of years? It was once bonds and stocks 60-40. Then it was a question of whether you have ex-U.S. or U.S. Where are we right now?
Well, we're in a situation where, well, by the way, you mentioned the last couple of years, and we talked about the death of the 60-40. And let's first acknowledge that 2025, 60-40 performed tremendously well, as all assets did particularly well. But it's been a few years where diversification penalized you. It was all about market concentration in the U.S., within U.S. equities in the Max 7s, and in global equities, if you took the simplest step away from U.S. equities, you would have underperformed. The evidence now in the last few months is that that long-awaited broadening of market participation, particularly in equity markets, is really taking place. And it's not just in the price action. You're seeing a convergence between mid caps, small caps, and international, and U.S. equity, large caps. In international, of course, we've seen, due to the dollar, international markets have actually outperformed. But we are beginning to see it also in sectors. And it's not just price performance, you're beginning to see it in earnings revisions. For the first time in the last couple of months, we're seeing earnings revisions in international markets are now moving into positive territory and catching up with what was previously a divergence between U.S. equities and non-U.S. equities. So the expectations around fundamentals are also supporting that broadening market participation. And just the last data point, AI, Mag 7, tech, earnings growth expectations, 18%, the lowest in the last 4 years, still very strong, but the lowest in the last 4 years. and not too much ahead of the overall S&P 500. So that convergence is really happening. Diversification should begin to pay off again.
Let's play this out a bit more. We're going to be using this phrase Magnificent Seven in 2026? I know a lot of people think we should be using it now. Would be keen to retire it. But what does the conversation look like in the year ahead when it comes to these kind of hyperscalers and big tech?
I think from a fundamental perspective, the terminology Magnificent Seven and U.S. exceptionalism, from a fundamental perspective, is untouched. Right? We're talking about behemoths. We're talking about champions that in financial markets we have never seen before in terms of fundamental strength and nearly monopolistic conditions. But while the narrative will most likely play out, the price changes, right? It's all about expectations. These high growth stocks don't need to see negative earnings forecast or negative growth for them to sell off or to see underperformance relative to the other parts of the market. High growth stocks can simply see a still positive but lower growth rate to trigger that rotation into other sectors. Again, we're not calling for a sell-off, but we think that the proverbial unwind of the tech trade is more a rotation into other segments of the market rather than a crash in the tech trade.
So that recalibration of expectations, does it give you more confidence when you see results like we saw last week from Oracle or Broadcom, that's kind of a necessary evolution or growth that's taking place in terms of the way that we think about expectations?
That's very well put. I think the names that you're referring to and some of the developments, the headlines from last week, is that evolution. What do I mean by that? We spent the last 3 years where anything AI, anything tech related was a tailwind. There was a structural shift. Now, with substantial investment, substantial spending, we're entering now the phase where we will begin to see winners and losers. I am not in a position to say which one those winners and losers are from a single name perspective, but that's the evolution you're beginning to see. You're seeing two orbits now, the OpenAI orbit and the Alphabet orbit. And all of the companies that service and are exposed and have deals on the financing side or the contracting side with those two orbits. This large CapEx that we continue to see from a macro standpoint, some will see zero return on assets, or return on investment. Some will see very large payouts. And that's where the valuations will come down, because valuations coming down will be a reflection of a wider range, wider uncertainty, wider range of outcomes, rather than previously the expectation was for a much narrower range of outcomes.
Yeah, the show me moment for a lot of these AI names. Alessio de Longis, wonderful to see you. Thank you so much for being with us here. Alessio de Longis of Invesco. And David Gura, thank you so much for being with us. Truly awesome to have you as we look toward a really busy week and potentially the last real week of 2025. I shouldn't say that because a lot is going to happen, but a lot of people are going off. But we are going to be getting a host of economic data, Fed speak, as well as central bank decisions coming up tomorrow. Paul Canisi of JP Morgan, Stephanie Roth of Wolfe Research, Monica Guerra of Morgan Stanley, and Francis Donald of RBC Capital Markets as we count you down to non-farm payrolls for November. We finally get the data, as well as retail sales. Thank you so much for being with us. That was Bloomberg Surveillance. Good morning.